Accumulation Swing Index. Overview. The Accumulation Swing Index is a cumulative total of the swing index. The Accumulation Swing Index was developed by Wells Wilder. Interpretation. Mr. Wilder said, somewhere amidst the maze of open, high, low, and close prices is a phantom line that is the real market. The Accumulation Swing Index attempts to show this phantom line. Since the Accumulation Swing Index attempts to show the real market, it closely resembles prices themselves. This allows you to use classic support/resistance analysis on the index itself. Typical analysis involves looking for breakouts, new highs and lows, and divergences. Wilder notes the following characteristics of the Accumulation Swing Index. Home page, www.ntvforex.com, Forex News, www.ntvforex.com/news. It provides a numerical value that quantifies price swings. It defines short-term swing points. It cuts through the maze of high, low, and close prices and indicates the real strength and direction of the market. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows corn and its Accumulation Swing Index. You can see that the breakouts of the price trend lines labeled A and B were confirmed by breakouts of the Accumulation Swing Index trend lines labeled A and B. Calculation. The Accumulation Swing Index is a cumulative total of the swing index. The swing index and the Accumulation Swing Index require opening prices. Step-by-step instructions on calculating the swing index are provided in Wilder's book. New Concepts in Technical Trading Systems. Advance/decline line. Overview. The advance/decline line, A/D line, is undoubtedly the most widely used measure of market breadth. It is a cumulative total of the advancing declining issues indicator. When compared to the movement of a market index, example Dow Jones Industrials, S&P 500, etc., the A/D line has proven to be an effective gauge of the stock market's strength. Interpretation. The A/D line is helpful when measuring overall market strength. When more stocks are advancing than declining, the A/D line moves up, and vice versa. Technical analysis from A to Z. By Stephen B. Achelis. Many investors feel that the A/D line shows market strength better than more commonly used indices such as the Dow Jones Industrial Average, DJIA, or the S&P 500 index. By studying the trend of the A/D line you can see if the market is in a rising or falling trend, if the trend is still intact, and how long the current trend has prevailed. Another way to use the A/D line is to look for a divergence between the DJIA, or a similar index, and the A/D line. Often, an end to a bull market can be forecast when the A/D line begins to round over while the DJIA is still trying to make new highs. Historically, when a divergence develops between the DJIA and the A/D line, the DJIA has corrected and gone the direction of the A/D line. A military analogy is often used when discussing the relationship between the A/D line and the DJIA. The analogy is that trouble looms when the generals lead, example the DJIA is making new highs, and the troops refuse to follow, example the A/D line fails to make new highs. Example. The following chart shows the DJIA and the A/D line. The DJIA was making new highs during the 12 months leading up to the 1987 crash. During this same period, the A/D line was failing to reach new highs. This type of divergence, where the generals lead and the troops refuse to follow, usually results in the generals retreating in defeat as happened in 1987. Technical analysis from A to Z. By Stephen B. Achelis. Calculation. Table 2. Date. Advancing declining ADA/D line. February 15, 94 1198. 882. 316. 316. February 16, 94 1183. 965. 218. 534. February 17, 94 882. 1251. Minus 369 165. February 18, 94 706. 1411. Minus 705 minus 540. February 22, 94 1139. 1003. 136. Minus 404. Because the A/D line always starts at 0, the numeric value of the A/D line is of little importance. What is important is the slope and pattern of the A/D line. Advance/decline ratio. Overview. The advance/decline ratio, A/D ratio, shows the ratio of advancing issues to declining issues. It is calculated by dividing the number of advancing issues by the number of declining issues. Interpretation. The A/D ratio is similar to the advancing declining issues in that it displays market breadth. But, where the advancing declining issue subtracts the advancing/declining values, the A/D ratio divides the values. The advantage of the ratio is that it remains constant regardless of the number of issues that are traded on the New York Stock Exchange, which has steadily increased. A moving average of the A/D ratio is often used as an overbought/oversold indicator. The higher the value, the more excessive the rally and the more likely a correction. Likewise, low readings imply an oversold market and suggest a technical rally. Keep in mind, however, that markets that appear to be extremely overbought or oversold may stay that way for some time. When investing using overbought and oversold indicators, it is wise to wait for the prices to confirm your belief that a change is due before placing your trades. Day-to-day fluctuations of the advance/decline ratio are often eliminated by smoothing the ratio with a moving average. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows the S&P 500 and a 15-day moving average of the A/D ratio. You can see that prices usually declined after entering the overbought level above 1.25 sell arrows, and that they usually rallied after entering the oversold level below 0.90 buy arrows. Calculation. The A/D ratio is calculated by dividing the number of stocks that advanced in price for the day by the number of stocks that declined. Table 3 shows the calculation of the A/D ratio. Table 3. Date. Advancing declining A/D ratio. February 15, 94 1198. 882. 1.3583. February 16, 94 1183. 965. 1.2259. February 17, 94 882. 1251. 0.7050. February 18, 94 706. 1411. 0.5004. February 22, 94 1139. 1003. 1.1356. Technical analysis from A to Z. By Stephen B. Achelis. Advancing declining issues. Overview. The advancing declining issues is a market momentum indicator which shows the difference between stocks listed on the New York Stock Exchange that advanced in price minus those that declined. As of this writing, about 2,500 issues trade each day on the NYSE. The difference between the number of advancing and declining issues is the foundation of many market breadth indicators. These indicators include the advance/decline line, advance/decline ratio, absolute breadth index, breadth thrust, McClellan oscillator, and summation index. Indicators that use advancing and declining issues in their calculations are called market breadth indicators. Interpretation: the advancing declining issues indicator shows the difference between the number of advancing issues and the number of declining issues. Plotted by itself, this indicator is helpful to determine daily market strength. Strong up days generally show readings of more than plus 1,000. Very weak days have readings of less than minus 1,000. I prefer to plot a 5 to 40-day exponential moving average of the advancing declining issues rather than the daily values themselves. The moving average creates an excellent short-term overbought/oversold indicator. Both the overbought/oversold indicator and the McClellan oscillator are created using moving averages of advancing minus declining issues. Example: the following chart shows the DJIA and a 40-day moving average of the advancing declining issues indicator. Technical analysis from A to Z. By Stephen B. Achelis. I drew buy arrows when the moving average rose above minus 50 and sell arrows when it fell below 125. Normally, I would use 100, but the strong uptrend during this period caused the indicator to have an upward bias. Calculation: the advancing declining issues is calculated simply by subtracting the number of declining issues from the number of advancing issues. The following table shows the calculation of the advancing declining issues. Table 4. Date: advancing declining A/D. February 15, 94 1198. 882. 316. February 16, 94 1183. 965. 218. February 17, 94 882. 1251. Minus 369. February 18, 94 706. 1411. Minus 705. February 22, 94 1139. 1003. 136. Advancing, declining, unchanged volume. Overview: advancing, declining, and unchanged volume are all market momentum indicators. They reflect movement on the New York Stock Exchange in millions of shares. Advancing volume is the total volume for all securities that advanced in price. Declining volume is the total volume for all securities that declined in price. And similarly, unchanged volume is the total volume for all securities that were unchanged in price. Interpretation: numerous indicators have been developed using up and down volume indicators. These indicators include the cumulative volume index, negative volume index, positive volume index, and the upside-downside ratio. Charts of the advancing or declining volume can be used to look for volume divergences, where advancing volume increases, but the market falls, to see if selling pressure is waning, to view daily trends, etc. Technical analysis from A to Z. By Stephen B. Achelis. Due to the erratic fluctuations in advancing and declining volume, I suggest you smooth the indicators with a 3 to 10-day moving average. Example: the following chart shows the S&P 500 and a 10-day moving average of advancing volume. A bearish divergence developed as prices tried to rally, trendline A, while the advancing volume was declining, trendline B. If you only looked at the S&P 500, you might think the market was gaining strength. The advancing volume showed the true picture and prices were forced to correct. Andrews pitchfork. Overview. Andrews pitchfork is a line study consisting of 3 parallel trend lines based on 3 points you select. This tool was developed by Dr. Alan Andrews. Interpretation. The interpretation of a pitchfork is based on normal trend line support and resistance. Principles. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart of Xerox shows an Andrews pitchfork. The pitchfork was displayed by selecting the 3 points shown. You can see how prices tended to walk along the trend lines. Calculation. The first trend line begins at the leftmost point selected, either a major peak or trough, and is drawn so it passes directly between the 2 rightmost points. This line is the handle of the pitchfork. The second and third trend lines are then drawn beginning at the 2 rightmost points, a major peak and a major trough, and are drawn parallel to the first line. These lines are the tines of the pitchfork. ARMS Index. Overview. The ARMS Index is a market indicator that shows the relationship between the number of stocks that increase or decrease in price, advancing/declining issues, and the volume associated with stocks that increase or decrease in price, advancing/declining volume. It is calculated by dividing the advance/decline ratio by the upside/downside ratio. The ARMS Index was developed by Richard Arms in 1967. Over the years, the index has been referred to by a number of different names. When Barron's published the first article on the indicator in 1967, they called it the Short-Term Trading Index. It has also been known as TRIN, an acronym for Trading Index, MKDS, and STKS. Technical analysis from A to Z. By Stephen B. Achelis. Interpretation. The ARMS Index is primarily a short-term trading tool. The index shows whether volume is flowing into advancing or declining stocks. If more volume is associated with advancing stocks than declining stocks, the ARMS Index will be less than 1.0, if more volume is associated with declining stocks, the index will be greater than 1.0. The index is usually smoothed with a moving average. I suggest using a 4-day moving average for short-term analysis, a 21-day moving average for intermediate term, and a 55-day moving average for longer-term analysis. Normally, the ARMS Index is considered bullish when it is below 1.0 and bearish when it is above 1.0. However, the index seems to work most effectively as an overbought/oversold indicator. When the indicator drops to extremely overbought levels, it is foretelling a selling opportunity. When it rises to extremely oversold levels, a buying opportunity is approaching. What constitutes an extremely overbought or oversold level depends on the length of the moving average used to smooth the indicator and on market conditions. Table 5 shows typical overbought and oversold levels. Table 5. Moving average overbought oversold. 4-day 0.70, 1.25, 21-day 0.85, 1.10, 55-day 0.90, 1.05. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart contains a 21-day moving average of the ARMS Index and the New York Stock Exchange Index. Horizontal lines are drawn at the oversold level of 1.08 and at the overbought level of 0.85. I drew buy arrows when the ARMS Index peaked above 1.08 and sell arrows when the index bottomed below 0.85. In most of the cases the arrows occur at, or 1 day Before, significant changes in price. Calculation. The ARMS index is calculated by first dividing the number of stocks that advanced in price by the number of stocks that declined in price to determine the advance/decline ratio. Next, the volume of advancing stocks is divided by the volume of declining stocks to determine the upside/downside ratio. Finally, the advance/decline ratio is divided by the upside/downside ratio. Average true range. Overview. The average true range, ATR, is a measure of volatility. It was introduced by Wells Wilder in his book, New Concepts in Technical Trading Systems, and has since been used as a component of many indicators and trading systems. Technical Analysis from A to Z. By Stephen B. Achelis. Interpretation. Wilder has found that high ATR values often occur at market bottoms following a panic sell-off. Low average true range values are often found during extended sideways periods, such as those found at tops and after consolidation periods. The average true range can be interpreted using the same techniques that are used with the other volatility indicators. Refer to the discussion on standard deviation for additional information on volatility interpretation. Example. The following chart shows McDonald's and its average true range. This is a good example of high volatility as prices bottom, points A and A, and low volatility as prices consolidate prior to a breakout, points B and B. Calculation. The true range indicator is the greatest of the following: the distance from today's high to today's low, the distance from yesterday's close to today's high, the distance from yesterday's close to today's low. The average true range is a moving average, typically 14 days, of the true ranges. Technical Analysis from A to Z. By Stephen B. Achelis. Bollinger Bands. Overview. Bollinger Bands are similar to moving average envelopes. The difference between Bollinger Bands and envelopes is envelopes are plotted at a fixed percentage above and below a moving average, whereas Bollinger Bands are plotted at standard deviation levels above and below a moving average. Since standard deviation is a measure of volatility, the bands are self-adjusting, widening during volatile markets and contracting during calmer periods. Bollinger Bands were created by John Bollinger. Interpretation. Bollinger Bands are usually displayed on top of security prices, but they can be displayed on an indicator. These comments refer to bands displayed on prices. As with moving average envelopes, the basic interpretation of Bollinger Bands is that prices tend to stay within the upper and lower band. The distinctive characteristic of Bollinger Bands is that the spacing between the bands varies based on the volatility of the prices. During periods of extreme price changes, i.e., high volatility, the bands widen to become more forgiving. During periods of stagnant pricing, i.e., low volatility, the bands narrow to contain prices. Mr. Bollinger notes the following characteristics of Bollinger Bands. Sharp price changes tend to occur after the bands tighten, as volatility lessens. When prices move outside the bands, a continuation of the current trend is implied. Bottoms and tops made outside the bands followed by bottoms and tops made inside the bands call for reversals in the trend. A move that originates at one band tends to go all the way to the other band. This observation is useful when projecting price targets. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows Bollinger Bands on Exxon's prices. The bands were calculated using a 20-day exponential moving average and are spaced 2 deviations apart. The bands were at their widest when prices were volatile during April. They narrowed when prices entered a consolidation period later in the year. The narrowing of the bands increases the probability of a sharp breakout in prices. The longer prices remain within the narrow bands, the more likely a price breakout. Calculation. Bollinger Bands are displayed as 3 bands. The middle band is a normal moving average. In the following formula, n is the number of time periods in the moving average, example 20 days. The upper band is the same as the middle band, but it is shifted up by the number of standard deviations, example 2 deviations. In this next formula, d is the number of standard deviations. Technical analysis from A to Z. By Stephen B. Achelis. The lower band is the moving average shifted down by the same number of standard deviations, i.e., d. Mr. Bollinger recommends using 20 for the number of periods in the moving average. Calculating the moving average using the simple method, as shown in the formula for the middle band, and using 2 standard deviations. He has also found that moving averages of less than 10 periods do not work very well. Breadth thrust. Overview. The breadth thrust indicator is a market momentum indicator. It was developed by Dr. Martin Zweig. The breadth thrust is calculated by dividing a 10-day exponential moving average of the number of advancing issues by the number of advancing plus declining issues. Interpretation. A breadth thrust occurs when, during a 10-day period, the breadth thrust indicator rises from below 40% to above 61.5%. A thrust indicates that the stock market has rapidly changed from an oversold condition to one of strength, but has not yet become overbought. According to Dr. Zweig, there have only been 14 breadth thrusts since 1945. The average gain following these 14 thrusts was 24.6% in an average time frame of 11 months. Dr. Zweig also points out that most bull markets begin with a breadth thrust. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows the S&P 500 and the breadth thrust indicator. Horizontal lines are drawn on the breadth thrust indicator at 40% and 61.5%. Remember that a thrust occurs when the indicator moves from below 40% to above 61.5% during a 10-day period. On December 18, 1984, I wrote the following comment regarding the breadth thrust indicator in a software manual. At the time this discussion on the breadth thrust is being written, December 18, 84, the NYSE has gained only 1.6% since the thrust. If the market fails to go higher in the next 6 to 12 months, it will be the first false signal generated by the breadth thrust indicator in 39 years. With historical average gains of almost 25%, we feel the odds are in our favor when we go with the thrust. As shown in the example, the NYSE did in fact go higher in the ensuing months. 12 months after the thrust occurred, the NYSE was up 21.6%. 21 months after the thrust occurred, the NYSE was up a whopping 51%. Trust the next thrust. Calculation. The breadth thrust is a 10-day simple moving average of the following. Technical analysis from A to Z. By Stephen B. Achelis. Bull/bear ratio. Overview. Each week a poll of investment advisors is taken and published by Investors Intelligence of New Rochelle, New York. Investment advisors are tracked as to whether they are bullish, bearish, or neutral on the stock market. The bull/bear ratio shows the relationship between the bullish and bearish advisors. Interpretation. The bull/bear ratio is a market sentiment indicator. Dr. Martin Zweig sums up sentiment indicators in his book Winning on Wall Street by saying, beware of the crowd when the crowd is too one-sided. Extreme optimism on the part of the public and even Professionals almost always coincides with market tops. Extreme pessimism almost always coincides with market bottoms. High readings of the bull/bear ratio are bearish, there are too many bulls, and low readings are bullish, there are not enough bulls. In almost every case, extremely high or low readings have coincided with market tops or bottoms. Historically, readings above 60% have indicated extreme optimism, which is bearish for the market, and readings below 40% have indicated extreme pessimism, which is bullish for the market. Example: the following chart shows the bull/bear ratio and the S&P 500. Buy arrows were drawn on the S&P 500 when the advisors were extremely bearish and sell arrows were drawn when advisors were extremely bullish. Technical analysis from A to Z. By Stephen B. Achelis. Calculation. The bull/bear ratio is calculated by dividing the number of bullish advisors by the number of bullish plus bearish advisors. The number of neutral advisors is ignored. Candlesticks, Japanese. Overview. In the 1600s, the Japanese developed a method of technical analysis to analyze the price of rice contracts. This technique is called candlestick charting. Stephen Nissen is credited with popularizing candlestick charting and has become recognized as the leading expert on their interpretation. Candlestick charts display the open, high, low, and closing prices in a format similar to a modern-day bar chart, but in a manner that extenuates the relationship between the opening and closing prices. Candlestick charts are simply a new way of looking at prices. They don't involve any calculations. Each candlestick represents one period, example day, of data. Figure 45 displays the elements of a candle. Technical analysis from A to Z. By Stephen B. Achelis. Interpretation. I have met investors who are attracted to candlestick charts by their mystique maybe. They are the long-forgotten Asian secret to investment analysis. Other investors are turned off by this mystique. They are only charts, right? Regardless of your feelings about the heritage of candlestick charting, I strongly encourage you to explore their use. Candlestick charts dramatically illustrate changes in the underlying supply/demand lines. Because candlesticks display the relationship between the open, high, low, and closing prices, they cannot be displayed on securities that only have closing prices, nor were they intended to be displayed on securities that lack opening prices. If you want to display a candlestick chart on a security that does not have opening prices, I suggest that you use the previous day's closing prices in place of opening prices. This technique can create candlestick lines and patterns that are unusual, but valid. The interpretation of candlestick charts is based primarily on patterns. The most popular patterns are explained below. Bullish patterns. Long white, empty, line. This is a bullish line. It occurs when prices open near the low and close significantly higher near the period's high. Hammer. This is a bullish line if it occurs after a significant downtrend. If the line occurs after a significant uptrend, it is called a hanging man. A hammer is identified by a small real body, i.e., a small range between the open and closing prices, and a long lower shadow, i.e., the low is significantly lower than the open, high, and close. The body can be empty or filled in. Technical analysis from A to Z. By Stephen B. Achelis. Piercing line. This is a bullish pattern and the opposite of a dark cloud cover. The first line is a long black line and the second line is a long white line. The second line opens lower than the first line's low, but it closes more than halfway above the first line's real body. Bullish engulfing lines. This pattern is strongly bullish if it occurs after a significant downtrend, i.e., it acts as a reversal pattern. It occurs when a small bearish, filled in, line is engulfed by a large bullish, empty, line. Morning star. This is a bullish pattern signifying a potential bottom. The star indicates a possible reversal and the bullish, empty, line confirms this. The star can be empty or filled in. Bullish doji star. A star indicates a reversal and a doji indicates indecision. Thus, this pattern usually indicates a reversal following an indecisive period. You should wait for a confirmation, example as in the morning star, above, before trading a doji star. The first line can be empty or filled in. Technical Analysis from A to Z. By Stephen B. Achelis. Bearish patterns. Long black, filled in, line. This is a bearish line. It occurs when prices open near the high and close significantly lower near the period's low. Hanging man. These lines are bearish if they occur after a significant uptrend. If this pattern occurs after a significant downtrend, it is called a hammer. They are identified by small real bodies, i.e., a small range between the open and closing prices, and a long lower shadow, i.e., the low was significantly lower than the open, high, and close. The bodies can be empty or filled in. Dark cloud cover. This is a bearish pattern. The pattern is more significant if the second line's body is below the center of the previous line's body, as illustrated. Bearish engulfing lines. This pattern is strongly bearish if it occurs after a significant uptrend, i.e., it acts as a reversal pattern. It occurs when a small bullish, empty, line is engulfed by a large bearish, filled in, line. Technical Analysis from A to Z. By Stephen B. Achelis. Evening star. This is a bearish pattern signifying a potential top. The star indicates a possible reversal and the bearish, filled in, line confirms this. The star can be empty or filled in. Doji star. A star indicates a reversal and a doji indicates indecision. Thus, this pattern usually indicates a reversal following an indecisive period. You should wait for a confirmation, example as in the evening star. Illustration, before trading a doji star. Shooting star. This pattern suggests a minor reversal when it appears after a rally. The star's body must appear near the low price and the line should have a long upper shadow. Technical Analysis from A to Z. By Stephen B. Achelis. Reversal patterns. Long-legged doji. This line often signifies a turning point. It occurs when the open and close are the same, and the range between the high and low is relatively large. Dragonfly doji. This line also signifies a turning point. It occurs when the open and close are the same, and the low is significantly lower than the open, high, and closing prices. Gravestone doji. This line also signifies a turning point. It occurs when the open, close, and low are the same, and the high is significantly higher than the open, low, and closing prices. Star. Stars indicate reversals. A star is a line with a small real body that occurs after a line with a much larger real body, where the real bodies do not overlap. The shadows may overlap. Technical Analysis from A to Z. By Stephen B. Achelis. Doji star. A star indicates a reversal and a doji indicates indecision. Thus, this pattern usually indicates a reversal following an indecisive period. You should wait for a confirmation, example as in the evening star. Illustration, before trading a doji star. Neutral patterns. Spinning tops. These are neutral lines. They occur when the distance between the high and low, and the distance between the open and close are relatively small. Dodgy. This line implies indecision. The security opened and closed at the same price. These lines can appear in several different patterns. Double dodgy lines, two adjacent dodgy lines, imply that a forceful move will follow a breakout from the current indecision. Harami, pregnant in English. This pattern indicates a decrease in momentum. It occurs when a line with a small body falls within the area of a larger body. In this example, a bullish, empty, line with a long body is followed by a weak bearish, filled-in, line. This implies a decrease in the bullish momentum. Technical Analysis from A to Z. By Stephen B. Achelis. Harami cross. This pattern also indicates a decrease in momentum. The pattern is similar to a harami, except the second line is a dodgy, signifying indecision. Example. The following chart of corn illustrates several Japanese candlestick patterns and principles. You can see that advancing prices are usually accompanied with empty lines, prices opened low and closed higher, and that declines are accompanied with filled-in lines. Prices opened high and closed lower. Bearish engulfing lines occurred at points A and B, and prices subsequently moved lower. Bullish white lines occurred at points 1, 2, and 3, as prices moved higher. CANSLIM. Overview. CANSLIM is an acronym for a stock market investment method developed by William O'Neill. O'Neill is the founder and chairman of Investors Business Daily, a national business newspaper. He also heads an investment research organization, William O'Neill and Company Incorporated. Technical Analysis from A to Z. By Stephen B. Achelis. Drawing from his study of the greatest money-making stocks from 1953 to 1985, O'Neill developed a set of common characteristics that each of these stocks possessed. The key characteristics to focus on are captured in the acronym CANSLIM. Current quarterly earnings per share. Annual earnings growth. New products, new management, new highs. Shares outstanding. Leading industry. Institutional sponsorship. Market direction. Although not strictly a technical analysis tool, the CANSLIM approach combines worthy technical and fundamental concepts. The CANSLIM approach is covered in detail in O'Neill's book, How to Make Money in Stocks. Interpretation. The following text summarizes each of the 7 components of the CANSLIM method. Current quarterly earnings. Earnings per share, EPS, for the most recent quarter should be up at least 20% when compared to the same quarter for the previous year, example first quarter of 1993 to the first quarter of 1994. Annual earnings growth. Earnings per share over the last 5 years should be increasing at the rate of at least 15% per year. Preferably, the EPS should increase each year. However, a single year setback is acceptable if the EPS quickly recovers and moves back into new high territory. New products, new management, new highs. A dramatic increase in a stock's price typically coincides with something new. This could be a new product or service, a new CEO, a new technology, or even new high stock prices. One of O'Neill's most surprising conclusions from his research is contrary to what many investors feel to be prudent. Instead of adhering to the old stock market maxim, buy low and sell high, O'Neill would say, buy high and sell higher. O'Neill's research concluded that the ideal time to purchase a stock is when it breaks into new high territory after going through a 2 to 15 month consolidation period. Some of the most dramatic increases follow such a breakout, due possibly to the lack of resistance, i.e., sellers Technical Analysis from A to Z. By Stephen B. Achelis. Shares outstanding. More than 95% of the stocks in Onal's study of the greatest stock market winners had less than 25 million shares outstanding. Using the simple principles of supply and demand, restricting the shares outstanding forces the supply line to shift upward, which results in higher prices. A huge amount of buying, i.e., demand, is required to move a stock with 400 million shares outstanding. However, only a moderate amount of buying is required to propel a stock with only 4 to 5 million shares outstanding, particularly if a large amount is held by corporate insiders. Leader. Although there is never a satisfaction guaranteed label attached to a stock, O'Neill found that you could significantly increase your chances of a profitable investment if you purchase a leading stock in a leading industry. He also found that winning stocks are usually outperforming the majority of stocks in the overall market as well. Institutional sponsorship. The biggest source of supply and demand comes from institutional buyers, example mutual funds, banks, insurance companies, etc. A stock does not require a large number of institutional sponsors, but institutional sponsors certainly give the stock a vote of approval. As a rule of thumb, O'Neill looks for stocks that have at least 3 to 10 institutional sponsors with better than average performance records. However, too much sponsorship can be harmful. Once a stock has become institutionalized, it may be too late. If 70 to 80% of a stock's outstanding shares are owned by institutions, the well may have run dry. The result of excessive institutional ownership can translate into excessive selling if bad news strikes. O'Neill feels the ideal time to purchase a stock is when it has just become discovered by several quality institutional sponsors, but before it becomes so popular that it appears on every institution's hot list. Market direction. This is the most important element in the formula. Even the best stocks can lose money if the general market goes into a slump. Approximately 75% of all stocks move with the general market. This means that you can pick stocks that meet all the other criteria perfectly, yet if you fail to determine the direction of the general market, your stocks will probably perform poorly. Technical Analysis from A to Z. By Stephen B. Achelis. Market indicators are designed to help you determine the conditions of the overall market. O'Neill says, learn to interpret a daily price and volume chart of the market averages. If you do, you can't get too far off the track. You really won't need much else, unless you want to argue with the trend of the market. Chaikin Oscillator. Overview. Inspired by the prior work of Joe Granville and Larry Williams, Mark Chaikin developed a new volume indicator, extending the work done by his predecessors. The Chaikin oscillator is a moving average oscillator based on the accumulation/distribution indicator. Interpretation. The following discussion of volume accumulation/distribution interpretation, written by Mark Chaikin, is reprinted here with his permission. Technical analysis of both market averages and individual stocks must include volume studies in order to give the technician a true picture of the internal dynamics of a given market. Volume analysis helps in identifying internal strengths and weaknesses that exist under the cover of price action. Very often, volume divergences versus price movement are the only clues to an important reversal that is about to take place. While volume has always been mentioned by technicians as important, little effective volume work was done until Joe Granville and Larry Williams began to look at volume versus price in the late 1960s in a more creative way. For many years it had been accepted that volume and price normally rose and fell together, but when this relationship changed, the price action should be examined for a possible change of trend. The Granville OBV concept, which views the total volume on an up day as accumulation and the total volume on a down day as distribution, is a decent one, but much too simplistic to be of value. The reason is that there are too many important tops and bottoms, both short-term and intermediate term, where OBV confirms the price extreme. However, when an OBV line gives a divergence signal versus a price extreme, it can be a valuable technical signal and usually triggers a reversal in price. Larry Williams took the OBV concept and improved on it. In order to determine whether there was accumulation or distribution in the market or an individual stock on a given day, Granville compared the closing price to the previous close, whereas Williams compared the closing price to the opening price. Williams created a cumulative line by adding a percentage of total volume to the line if the close was higher than the opening and subtracting a percentage of the total volume if the close was lower than its opening price. The accumulation/distribution line improved results dramatically over the classic OBV approach to volume divergences. Technical Analysis from A to Z by Stephen B. Achelis. Williams then took this one step further in analyzing the Dow Jones Industrials by creating an oscillator of the accumulation/distribution line for even better buy and sell signals. In the early 1970s, however, the opening price for stocks was eliminated from the daily newspaper and Williams' formula became difficult to compute without many daily calls to a stockbroker with a quote machine. Because of this void, I created the Chaikin oscillator, substituting the average price of the day for Williams' opening, and took the approach one step further by applying the oscillator to stocks and commodities. The Chaikin oscillator is an excellent tool for generating buy and sell signals when its action is compared to price movement. I believe it is a significant improvement over the work that preceded it. The premise behind my oscillator is threefold. The first premise is that if a stock or market average closes above its midpoint for the day, as defined by high and low/2, then there was accumulation on that day. The closer a stock or average closes to its high, the more accumulation there was. Conversely, if a stock closes below its midpoint for the day, there was distribution on that day. The closer a stock closes to its low, the more distribution there was. The second premise is that a healthy advance is accompanied by rising volume and a strong volume accumulation. Since volume is the fuel that powers rallies, it follows that lagging volume on rallies is a sign of less fuel available to move stocks higher. Conversely, declines are usually accompanied by low volume, but end with panic-like liquidation on the part of institutional investors. Thus, we look for a pickup in volume, and then lower lows on reduced volume with some accumulation before a valid bottom can develop. The third premise is that by using the Chaikin oscillator, you can monitor the flow of volume into and out of the market. Comparing this flow to price action can help identify tops and bottoms, both short-term and intermediate term. Since no technical approach works all the time, I suggest using the oscillator along with other technical indicators to avoid problems. I favor using a price envelope around a 21-day moving average and an overbought/oversold oscillator together with the Chaikin oscillator for the best short and intermediate term technical signals. The most important signal generated by the Chaikin oscillator occurs when prices reach a new high or new low for a swing, particularly at an overbought or oversold level, and the oscillator fails to exceed its previous extreme reading and then reverses direction. Once signals in the direction of the intermediate term trend are more reliable than those against the trend. 2. A confirmed high or low does not imply any further price action in that direction. I view that as a non-event. Technical Analysis from A to Z By Stephen B. Achelis. A second way to use the Chaikin oscillator is to view a change of direction in the oscillator as a buy or sell signal, but only in the direction of the trend. For example, if we say that a stock that is above its 90-day moving average of price is in an uptrend, then an upturn of the oscillator while in negative territory would constitute a buy signal only if the stock were above its 90-day moving average, not below it. A downturn of the oscillator while in positive territory, above zero, would be a sell signal if the stock were below its 90-day moving average of closing prices. Example. The following chart shows Eastman Kodak and the Chaikin oscillator. Bearish divergences, where prices increased to new highs while the oscillator was falling, occurred at points A and B. These divergences were warnings of the sell-offs that followed. Calculation. The Chaikin oscillator is created by subtracting a 10-period exponential moving average of the accumulation/distribution line from a 3-period exponential moving average of the accumulation/distribution line. Commodity Channel Index. Overview. The Commodity Channel Index, CCI, measures the variation of a security's price from its statistical mean. High values show that prices are unusually high compared to average prices, whereas low values indicate that prices are unusually low. Contrary to its name, the CCI can be used effectively on any type of security, not just commodities. Technical Analysis from A to Z. By Stephen B. Achelis. The CCI was developed by Donald Lambert. Interpretation. There are two basic methods of interpreting the CCI, looking for divergences and as an overbought/oversold indicator. A divergence occurs when the securities prices are making new highs while the CCI is failing to surpass its previous highs. This classic divergence is usually followed by a correction in the securities price. The CCI typically oscillates between 100. To use the CCI as an overbought/oversold indicator, readings above +100 imply an overbought condition, and a pending price correction, while readings below -100 imply an oversold condition, and a pending rally. Example. The following chart shows the British pound and its 14-day CCI. A bullish divergence occurred at point A. Prices were declining as the CCI was advancing. Prices subsequently rallied. A bearish divergence occurred at point B. Prices were advancing while the CCI was declining. Prices corrected. Note too, that each of these divergences occurred at extreme levels, i.e., above +100 or below -100, making them even more significant. Calculation. A complete explanation of the CCI calculation is beyond the scope of this book. The following are basic steps involved in the calculation. Technical Analysis from A to Z. By Stephen B. Achelis. 1. Add each period's high, low, and close and divide this sum by 3. This is the typical price. 2. Calculate an end-period simple moving average of the typical prices computed in Step 1. 3. For each of the prior n periods, subtract today's Step 2 value from Step 1's value n days ago. For example, if you were calculating a 5-day CCI, you would perform 5 subtractions using today's Step 2 value. 4. Calculate an n-period simple moving average of the absolute values of each of the results in Step 3. 5. Multiply the value in Step 4 by 0.015. 6. Subtract the value from Step 2 from the value in Step 1. 7. Divide the value in Step 6 by the value in Step 5. Further details on the contents and interpretation of the CCI can be found in an article by Donald Lambert that appeared in the October 1980 issue of Commodities, now known as Futures, Magazine. Commodity Selection Index. Overview. The Commodity Selection Index, CSI, is a momentum indicator. It was developed by Welles Wilder and is presented in his book New Concepts in Technical Trading Systems. The name of the index reflects its primary purpose. That is, to help select commodities suitable for short-term trading. Interpretation. A high CSI rating indicates that the commodity has strong trending and volatility. Characteristics. The trending characteristics are brought out by the directional movement. Factor in the calculation the volatility characteristic by the average true range factor. Wilder's approach is to trade commodities with high CSI values, relative to other commodities. Because these commodities are highly volatile, they have the potential to make the most money in the shortest period of time. High CSI values imply trending characteristics which make it easier to trade the security. The Commodity Selection Index is designed for short-term traders who can handle the risks associated with highly volatile markets. Example. The following chart shows the Japanese yen and its 14-day CSI. Strong volatility and strong trends result in high CSI values at points A and B. Technical Analysis from A to Z. By Stephen B. Achelis. Calculation. It is beyond the scope of this book to provide full calculation details on the commodity selection index. It is calculated using the ADXR component of the directional movement indicator. Wilder's book New Concepts in Technical Trading Systems contains detailed information on the calculation of the CSI. Correlation Analysis. Overview. Correlation analysis measures the relationship between two items, for example, a securities price and an indicator. The resulting value, called the correlation coefficient, shows if changes in one item, example an indicator, will result in changes in the other item. Example the securities price. Interpretation. When comparing the correlation between two items, one item is called the dependent item and the other the independent item. The goal is to see if a change in the independent item, which is usually an indicator, will result in a change in the dependent item, usually a securities price. This information helps you understand an indicator's predictive abilities. The correlation coefficient can range between 1.0, plus or minus 1. A coefficient of plus 1.0, a perfect positive correlation, means that changes in the independent item will result in an identical change in the dependent item, example a change in the indicator will result in an identical change in the securities price. A coefficient of minus 1.0, a perfect negative correlation, means that changes in the independent item will result in an identical change in the dependent item, but the change will be in the opposite direction. A. Technical Analysis from A to Z. By Stephen B. Achelis. Coefficient of 0 means there is no relationship between the two items and that a change in the independent item will have no effect in the dependent item. A low correlation coefficient, example less than 0.10, suggests that the relationship between two items is weak or non-existent. A high correlation coefficient, i.e., closer to plus or minus 1, indicates that the dependent variable, example the securities price, will usually change when the independent variable, example an indicator, changes. The direction of the dependent variable's change depends on the sign of the coefficient. If the coefficient is a positive number, then the dependent variable will move in the same direction as the independent variable. If the coefficient is negative, then the dependent variable will move in the opposite direction of the independent variable. You can use correlation analysis in two basic ways, to determine the predictive ability of an indicator and to determine the correlation between two securities. When comparing the correlation between an indicator and a securities price, A high positive coefficient, example move then plus 0.70, tells you that a change in the indicator will usually predict a change in the security's price. A high negative correlation, example less than minus 0.70, tells you that when the indicator changes, the security's price will usually move in the opposite direction. Remember, a low, example close to 0, coefficient indicates that the relationship between the security's price and the indicator is not significant. Correlation analysis is also valuable in gauging the relationship between two securities. Often, one security's price leads or predicts the price of another security. For example, the correlation coefficient of gold versus the dollar shows a strong negative relationship. This means that an increase in the dollar usually predicts a decrease in the price of gold. Example: the following chart shows the relationship between corn and live hogs. The high correlation values show that, except during brief periods in February and May, there is a strong relationship between the price of these items, i.e., when the price of corn changes, the price of live hogs also moves in the same direction. Technical Analysis from A to Z. By Stephen B. Achelis. Cumulative Volume Index. Overview. The Cumulative Volume Index, CVI, is a market momentum indicator that shows whether money is flowing into or out of the stock market. It is calculated by subtracting the volume of declining stocks from the volume of advancing stocks, and then adding this value to a running total. See advancing, declining, and unchanged volume. Interpretation. The CVI and OBV, on balance volume, are quite similar. Many computer programs and investors incorrectly call the OBV the CVI. OBV, like the CVI, was designed to show if volume is flowing into or out of the market. But, because up volume and down volume are not available for individual stocks, OBV assumes that all volume is up volume when the stock closes higher and that all volume is down volume when the stock closes lower. The CVI does not have to make this large assumption, because it can use the actual up and down volume for the New York Stock Exchange. One useful method of interpreting the CVI is to look at its overall trend. The CVI shows whether there has been more up volume or down volume and how long the current volume trend has been in place. Also, look for divergences that develop between the CVI and a market index. For example, is the market index making a new high while the CVI fails to reach new highs? If so, it is probable that the market will correct to confirm the underlying story told by the CVI. For additional information on interpreting the CVI, refer to the discussion on OBV. Example: I wrote the following discussion on the CVI in a software manual in July 18, 1984. Technical Analysis from A to Z. By Stephen B. Achelis. The trend line on the chart below shows that up volume exceeded down volume, on average, for all of 1983. When this rising trend was broken, in February of 1984, the market's weakness was confirmed. Since breaking down through its rising trend line, the CVI has begun to trend upward, and sideways, once again. While the market has been down, up volume has exceeded or equaled down volume, the CVI is trending upward again. There are two different ways to interpret this. Some investors feel that because the market has failed to go up, even though up volume has exceeded, or at least kept pace with, down volume, that the overhead supply is too great. After all, if the market falls when there is more up volume than down volume, what is going to happen when there is more down volume than up volume? An opposing school of thought is that the CVI shows what the smart money is doing. Therefore, since money is flowing into the market on the upside, the NYSE should soon correct the divergence and rise too. Now that I have the advantage of retrospect, we can see that the CVI was in fact showing what the smart money was doing. Shortly after the above commentary was written, the market broke, corrected the divergence, and rose sharply. Calculation. The cumulative volume index is calculated by subtracting the volume of declining stocks from the volume of advancing stocks, and then adding this value to a cumulative total. Technical analysis from A to Z. By Stephen B. Achelis. Table 6 shows the calculation of the CVI. Table 6. Date. Advancing declining AD CVI. February 15, 94 175. 87. 88. 88. February 16, 94 132. 129. 3. 91. February 17, 94 122. 183. Minus 61. 30. February 18, 94 79. 171. Minus 92. Minus 62. February 22, 94 160. 80. 80. 18. Because the CVI always starts at 0, the numeric value of the CVI is of little importance. What is important is the slope and pattern of the CVI. Cycles. Overview. Cycles allow us to accurately predict events in nature, bird migrations, the tides, planetary movements, etc. You can also use cycle analysis to predict changes in financial markets, although not always with the accuracy found in nature. The prices of many commodities reflect seasonal cycles. Due to the agricultural nature of most commodities, these cycles are easily explained and understood. However, for some securities, the cyclical nature is more difficult to explain. Theories as to why certain securities exhibit cyclical patterns range from weather and sunspots, to planetary movement and basic human psychology. I feel human psychology is responsible. We know that prices are a consensus of human expectations. These expectations are always changing, shifting the supply/demand lines, and causing prices to oscillate between overbought and oversold levels. Fluctuations in prices are a natural process of changing expectations and lead to cyclical patterns. Many technical analysis indicators and tools were developed in an attempt to profit from the cyclical nature of prices. For example, overbought/oversold indicators, example, stochastic, RSI, etc., are designed to help you determine the excessive boundaries of a cycle. Technical analysis from A to Z. By Stephen B. Achelis. The following illustration shows the major components of a cycle. Interpretation. An entire book could easily be filled with a discussion of cycles and cycle analysis. In the following sections, I briefly explain some of the more popular cycles. A good starting point to learn more about cycles, and technical analysis in general, is Martin Pring's book, Technical Analysis Explained. Keep in mind that, in hindsight, you can find patterns in anything. To successfully profit from cycle analysis, the cycle should have a strong track record and be used in conjunction with other trading tools. 28-day trading cycle. Research in the 1930s found a 28-day cycle in the wheat market. Some attribute this to the lunar cycle. Regardless of the cause, many markets, including stocks, do appear to have a 28-day cycle. The 28-day cycle is calendar days. This is approximately 20 trading days. 10 minus a half-month futures cycle. Although individual commodities exhibit their own unique cycles, A cycle ranging between 9 and 12 months has been found in the CRB. Commodity Research Bureau, Index. January effect. The stock market has shown an uncanny tendency to end the year higher. If prices increase during the month of January, and to end the year with lower prices if prices decline during January. The saying is, so goes January, so goes the rest of the year. Between 1950 and 1993, the January effect was correct 38 out of 44 times an accuracy of 86%. 4-year cycle, Kitchen wave. In 1923, Joseph Kitchen found that a 40-month cycle existed in a variety of financial items in both Great Britain and the United States between. Technical Analysis from A to Z. By Stephen B. Achelis. 1890 and 1922. The 4-year cycle was later found to have an extremely strong presence in the stock market between 1868 and 1945. Although it is called a 4-year cycle, the cycle length has been found to vary between 40 and 53 months. Presidential cycle. This cycle is based on the presidential election that occurs every 4 years in the United States. The concept is that stock prices will decline following the election as the newly elected president takes unpopular steps to make adjustments to the economy. Then midterm, stock prices will begin to rise in anticipation of a strong election day economy. 9.2-year cycle, Huglar wave. In 1860, Clement Huglar found that a cycle lasting approximately 9 years existed in many areas of economic activity. Subsequent research found this cycle to have had a strong presence during the period of 1840 to 1940. 54-year cycle, Kondratiev wave. Named after a Russian economist, the Kondratiev wave is a long-term, 54-year cycle identified in prices and economic activity. Since the cycle is extremely long-term, it has only repeated itself 3 times in the stock market. The up wave is characterized by rising prices, a growing economy, and mildly bullish stock markets. The plateau is characterized by stable prices, peak economic capacity, and strong bullish stock markets. The down wave is characterized by falling prices, severe bear markets, and often by a major war. The following chart of the Kondratiev wave, from the Media General Financial Weekly, June 3, 1974, shows the Kondratiev wave and U.S. wholesale prices. Technical Analysis from A to Z. By Stephen B. Achelis. Demand Index. Overview. The demand index combines price and volume in such a way that it is often a leading indicator of price change. The demand index was developed by James Sabet. Interpretation. Mr. Sabet defines 6 rules for the demand index. 1. A divergence between the demand index and prices suggests an approaching weakness in price. 2. Prices often rally to new highs following an extreme peak in the demand index. The index is performing as a leading indicator. 3. Higher prices with a lower demand index peak usually coincides with an important top, the index is performing as a coincidental indicator. 4. The demand index penetrating the level of 0 indicates a change in trend, the index is performing as a lagging indicator. 5. When the demand index stays near the level of 0 for any length of time, it usually indicates a weak price movement that will not last long. 6. A large long-term divergence between prices and the demand index indicates a major top or bottom. Example. The following chart shows Procter & Gamble and the demand index. A long-term bearish divergence occurred in 1992 as prices rose while the demand index fell. According to Sabet, this indicates a major top. Technical Analysis from A to Z. By Stephen B. Achelis. Calculation. The demand index calculations are too complex for this book, they require 21 columns of data. Sabase original index plotted the indicator on a scale labeled +0 at the top, 1 in the middle, and -0 at the bottom. Most computer software makes a minor modification to the indicator so it can be scaled on a normal scale. Detrended price oscillator. Overview. The detrended price oscillator, DPO, attempts to eliminate the trend in prices. Detrended prices allow you to more easily identify cycles and overbought/oversold levels. Interpretation. Long-term cycles are made up of a series of short-term cycles. Analyzing these shorter-term components of the long-term cycles can be helpful in identifying major turning points in the longer-term cycle. The DPO helps you remove these longer-term cycles from prices. To calculate the DPO, you specify a time period. Cycles longer than this time period are removed from prices, leaving the shorter-term cycles. Example. The following chart shows the 20-day DPO of Rider. You can see that minor peaks in the DPO coincided with minor peaks in Rider's price, but the longer-term price trend. Technical analysis from A to Z. By Stephen B. Achelis. During June was not reflected in the DPO. This is because the 20-day DPO removes cycles of more than 20 days. Calculation. To calculate the detrended price oscillator, first create an n-period simple moving average, where n is the number of periods in the moving average. Now, subtract the moving average, n/2, plus 1 days ago, from the closing price. The result is the DPO. Directional movement. Overview. The directional movement system helps determine if a security is trending. It was developed by Welles Wilder and is explained in his book, New Concepts in Technical Trading Systems. Interpretation. The basic directional movement trading system involves comparing the 14-day and directional indicator, and the 14-day DI. This can be done by plotting the two indicators on top of each other or by subtracting the and from the DI. Wilder suggests buying when the and rises above the D and selling when the and falls below the DI. Technical analysis from A to Z. By Stephen B. Achelis. Wilder qualifies these simple trading rules with the extreme point rule. This rule is designed to prevent whipsaws and reduce the number of trades. The extreme point rule requires that on the day that the and D cross, you note the extreme point. When the and rises above the D, the extreme price is the high price on the day the lines cross. When the and falls below the D, the extreme price is the low price on the day the lines cross. The extreme point is then used as a trigger point at which you should implement the trade. For example, after receiving a buy signal, the and rose above the DI, you should then wait until the security's price rises above the extreme point, the high price on the day that the and D lines crossed, before buying. If the price fails to rise above the extreme point, you should continue to hold your short position. In Wilder's book, he notes that this system works best on securities that have a high commodity selection index. He says, as a rule of thumb, the system will be profitable on commodities that have a CSI value above 25. When the CSI drops below 20, then do not use a trend-following system. Example. The following chart shows Texaco and the and D indicators. I drew buy arrows when the and D rose above the D and sell arrows when the and D fell below the D. I only labeled the significant crossings and did not label the many short-term crossings. Calculation. The calculations of the directional movement system are beyond the scope of this book. Wilder's book, New Concepts in Technical Trading, gives complete step-by-step instructions on the calculation and interpretation of these indicators. Technical Analysis from A to Z. By Stephen B. Achelis. Dow Theory. Overview. In 1897, Charles Dow developed two broad market averages. The industrial average included 12 blue-chip stocks, and the rail average was comprised of 20 railroad enterprises. These are now known as the Dow Jones Industrial Average and the Dow Jones Transportation Average. The Dow theory resulted from a series of articles published by Charles Dow in the Wall Street Journal between 1900 and 1902. The Dow theory is the common ancestor to most principles of modern technical analysis. Interestingly, the theory itself originally focused on using general stock market trends as a barometer for general business conditions. It was not originally intended to forecast stock prices. However, subsequent work has focused almost exclusively on this use of the theory. Interpretation. The Dow theory comprises 6 assumptions. 1. The averages discount everything. An individual stock's price reflects everything that is known about the security. As new information arrives, market participants quickly disseminate the information and the price adjusts accordingly. Likewise, the market averages discount and reflect everything known by all stock market participants. 2. The market is comprised of 3 trends. At any given time in the stock market, 3 forces are in effect: the primary trend, secondary trends, and minor trends. The primary trend can either be a bullish, rising, market or a bearish, falling, market. The primary trend usually lasts more than 1 year and may last for several years. If the market is making successive higher highs and higher lows, the primary trend is up. If the market is making successive lower highs and lower lows, the primary trend is down. Secondary trends are intermediate, corrective reactions to the primary trend. These reactions typically last from 1 to 3 months and retrace from 1/3 to 2/3 of the previous secondary trend. The following chart shows a primary trend, line A, and 2 secondary trends, B and C. Technical Analysis from A to Z. By Stephen B. Achelis. Minor trends are short-term movements lasting from 1 day to 3 weeks. Secondary trends are typically comprised of a number of minor trends. The Dow theory holds that since stock prices over the short term are subject to some degree of manipulation, primary and secondary trends are not, minor trends are unimportant and can be misleading. 3 primary trends have 3 phases. The Dow theory says that the first phase is made up of aggressive buying by informed investors in anticipation of economic recovery and long-term growth. The general feeling among most investors during this phase is one of gloom and doom and disgust. The informed investors, realizing that a turnaround is inevitable, aggressively buy from these distressed sellers. The second phase is characterized by increasing corporate earnings and improved economic conditions. Investors will begin to accumulate stock as conditions improve. The third phase is characterized by record corporate earnings and peak economic conditions. The general public, having had enough time to forget about their last scathing, now feels comfortable participating in the stock market, fully convinced that the stock market is headed for the moon. They now buy even more stock, creating a buying frenzy. It is during this phase that those few investors who did the aggressive buying during the first phase begin to liquidate their holdings in anticipation of a downturn. The following chart of the Dow Industrials illustrates these 3 phases during the years leading up to the October 1987 crash. Technical Analysis from A to Z. By Stephen B. Achelis. In anticipation of a recovery from the recession, informed investors began to accumulate stock during the first phase, box A. A steady stream of improved earnings reports came in during the second phase, Box B, causing more investors to buy stock. Euphoria set in during the third phase, Box C, as the general public began to aggressively buy stock. 4. The averages must confirm each other. The industrials and transports must confirm each other in order for a valid change of trend to occur. Both averages must extend beyond their previous secondary peak, or trough, in order for a change of trend to be confirmed. The following chart shows the Dow Industrials and the Dow Transports at the beginning of the bull market in 1982. Confirmation of the change in trend occurred when both averages rose above their previous secondary peak. Technical Analysis from A to Z. By Stephen B. Achelis. 5. The volume confirms the trend. The Dow theory focuses primarily on price action. Volume is only used to confirm uncertain situations. Volume should expand in the direction of the primary trend. If the primary trend is down, volume should increase during market declines. If the primary trend is up, volume should increase during market advances. The following chart shows expanding volume during an uptrend, confirming the primary trend. 6. A trend remains intact until it gives a definite reversal signal. An uptrend is defined by a series of higher highs and higher lows. In order for an uptrend to reverse, prices must have at least one lower high and one lower low. The reverse is true of a downtrend. When a reversal in the primary trend is signaled by both the industrials and transports, the odds of the new trend continuing are at their greatest. However, the longer a trend continues, the odds of the trend remaining intact become progressively smaller. The following chart shows how the Dow Industrials registered a higher high, point A, and a higher low, point B, which identified a reversal of the downtrend, line C. Technical Analysis from A to Z. By Stephen B. Achelis. Ease of movement. Overview. The ease of movement indicator shows the relationship between volume and price change. As with equivolume charting, this indicator shows how much volume is required to move prices. The ease of movement indicator was developed Richard W. Arms, Jr., the creator of equivolume. Interpretation. High ease of movement values occur when prices are moving upward on light volume. Low ease of movement values occur when prices are moving downward on light volume. If prices are not moving, or if heavy volume is required to move prices, then the indicator will also be near zero. The ease of movement indicator produces a buy signal when it crosses above zero, indicating that prices are moving upward more easily. A sell signal is given when the indicator crosses below zero, indicating that prices are moving downward more easily. Example. The following chart shows Compaq and a 14-day ease of movement indicator. A 9-day moving average was plotted on the ease of movement indicator. Technical Analysis from A to Z. By Stephen B. Achelis. Buy and sell arrows were placed on the chart when the moving average crossed zero. Calculation. To calculate the ease of movement indicator, first calculate the midpoint move as shown below. Next, calculate the high-low box ratio expressed in eighths with the denominator dropped. Example 1 minus a half points equals 12 eighths or just 12. The ease of movement, EMV, indicator is then calculated from the midpoint move and box ratio. The raw ease of movement value is usually smoothed with a moving average. Efficient market theory. Overview. The efficient market theory says that security prices correctly and almost immediately reflect all information and expectations. It says that you cannot consistently outperform the stock market due to the random nature in which information arrives and the fact that prices react and adjust almost immediately to reflect the latest information. Therefore, it assumes that at any given time, the market correctly prices all securities. The result, or so The theory advocates is that securities cannot be overpriced or underpriced for a long enough period of time to profit therefrom. Technical Analysis from A to Z. By Stephen B. Achelis. The theory holds that since prices reflect all available information, and since information arrives in a random fashion, there is little to be gained by any type of analysis, whether fundamental or technical. It assumes that every piece of information has been collected and processed by thousands of investors, and this information, both old and new, is correctly reflected in the price. Returns cannot be increased by studying historical data, either fundamental or technical, since past data will have no effect on future prices. The problem with both of these theories is that many investors base their expectations on past prices, whether using technical indicators, a strong track record, an oversold condition, industry trends, etc. And since investors' expectations control prices, it seems obvious that past prices do have a significant influence on future prices. Elliott wave theory. Overview. The Elliott wave theory is named after Ralph Nelson Elliott. Inspired by the Dow theory and by observations found throughout nature, Elliott concluded that the movement of the stock market could be predicted by observing and identifying a repetitive pattern of waves. In fact, Elliott believed that all of man's activities, not just the stock market, were influenced by these identifiable series of waves. With the help of C.J. Collins, Elliott's ideas received the attention of Wall Street in a series of articles published in Financial World magazine in 1939. During the 1950s and 1960s, after Elliott's passing, his work was advanced by Hamilton Bolton. In 1960, Bolton wrote Elliott Wave Principle, a critical appraisal. This was the first significant work since Elliott's passing. In 1978, Robert Prechter and A.J. Frost collaborated to write the book Elliott Wave Principle. Interpretation. The underlying forces behind the Elliott wave theory are of building up and tearing down. The basic concepts of the Elliott wave theory are listed below. 1. Action is followed by reaction. 2. There are 5 waves in the direction of the main trend, followed by 3 corrective waves, a 5 to 3 move. 3. A 5 to 3 move completes a cycle. This 5 to 3 move then becomes 2 subdivisions of the next higher 5 to 3 wave. 4. The underlying 5 to 3 pattern remains constant, though the time span of each may vary. Technical Analysis from A to Z. By Stephen B. Achelis. The basic pattern is made up of 8 waves, 5 up and 3 down, which are labeled 1, 2, 3, 4, 5, A, B, and C on the following chart. Waves 1, 3, and 5 are called impulse waves. Waves 2 and 4 are called corrective waves. Waves A, B, and C correct the main trend made by waves 1 through 5. The main trend is established by waves 1 through 5 and can be either up or down. Waves A, B, and C always move in the opposite direction of waves 1 through 5. Elliott wave theory holds that each wave within a wave count contains a complete 5 to 3 wave count of a smaller cycle. The longest wave count is called the grand supercycle. Grand supercycle waves are comprised of supercycles, and supercycles are comprised of cycles. This process continues into primary, intermediate, minute, and sub-minute waves. The following chart shows how 5 to 3 waves are comprised of smaller cycles. Technical Analysis from A to Z. By Stephen B. Achelis. This chart contains the identical pattern shown in the preceding chart, now displayed using dotted lines, but the smaller cycles are also displayed. For example, you can see that impulse wave labeled 1 in the preceding chart is comprised of 5 smaller waves. Fibonacci numbers provide the mathematical foundation for the Elliott wave theory. Briefly, the Fibonacci number sequence is made by simply starting at 1 and adding the previous number to arrive at the new number, i.e., 0 plus 1 equals 1, 1 plus 1 equals 2, 2 plus 1 equals 3, 3 plus 2 equals 5, 5 plus 3 equals 8, 8 plus 5 equals 13, etc. Each of the cycles that Elliott defined are comprised of a total wave count that falls within the Fibonacci number sequence. For example, the preceding chart shows two primary waves, an impulse wave and a corrective wave, 8 intermediate waves, the 5 to 3 sequence shown in the first chart, and 34-minute waves, as labeled. The numbers 2, 8, and 34 fall within the Fibonacci numbering sequence. Elliott wave practitioners use their determination of the wave count in combination with the Fibonacci numbers to predict the time span and magnitude of future market moves ranging from minutes and hours to years and decades. There is general agreement among Elliott wave practitioners that the most recent grand supercycle began in 1932 and that the final fifth wave of the cycle began at the market bottom in 1982. However, there has been much disparity since 1982. Many heralded the arrival of the October 1987 crash as the end of the cycle. The strong recovery that has since followed has caused them to re-evaluate their wave counts. Herein lies the weakness of the Elliott wave theory. Its predictive value is dependent on an accurate wave count. Determining where one wave starts and another wave ends can be extremely subjective. Envelopes, trading bands. Overview. An envelope is comprised of two moving averages. One moving average is shifted upward and the second moving average is shifted downward. Interpretation. Envelopes define the upper and lower boundaries of a security's normal trading range. A sell signal is generated when the security reaches the upper band, whereas a buy signal is generated at the lower band. The optimum percentage shift depends on the volatility of the security. The more volatile, the larger the percentage. The logic behind envelopes is that overzealous buyers and sellers push the price to the extremes, i.e., the upper and lower bands, at which point the prices often stabilize by moving to more realistic levels. This is similar to the interpretation of Bollinger Bands. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following chart displays American brands with a 6% envelope of a 25-day exponential moving average. You can see how American brands' price tended to bounce off the bands rather than penetrate them. Calculation. Envelopes are calculated by shifted moving averages. In the above example, one 25-day exponential moving average was shifted up 6% and another 25-day moving average was shifted down 6%. Equivolume. Overview. Equivolume displays prices in a manner that emphasizes the relationship between price and volume. Equivolume was developed by Richard W. Arms, Jr., and is further explained in his book Volume Cycles in the Stock Market. Instead of displaying volume as an afterthought on the lower margin of a chart, equivolume combines price and volume in a two-dimensional box. The top line of the box is the high for the period and the bottom line is the low for the period. The width of the box is the unique feature of equivolume. It represents the volume for the period. Technical Analysis from A to Z. By Stephen B. Achelis. Figure 46 shows the components of an equivolume box. The bottom scale on an equivolume chart is based on volume, rather than on dates. This suggests that volume, rather than time, is the guiding influence of price change. To quote Mr. Arms, if the market wore a wristwatch, it would be divided into shares, not hours. Candle volume. Candle volume charts are a unique hybrid of equivolume and candlestick charts. Candle volume charts possess the shadows and body characteristics of candlestick charts, plus the volume width attribute of equivolume charts. This combination gives you the unique ability to study candlestick patterns in combination with their volume-related movements. Interpretation. The shape of each equivolume box provides a picture of the supply and demand for the security during a specific trading period. Short and wide boxes, heavy volume, accompanied with small changes in price, tend to occur at turning points, while tall and narrow boxes, light volume accompanied with large changes in price, are more likely to occur in established trends. Especially important are boxes which penetrate support or resistance levels, since volume confirms penetrations. A power box is one in which both height and width increase substantially. Power boxes provide excellent confirmation to a breakout. A narrow box, due to light volume, puts the validity of a breakout in question. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following equivolume chart shows Philip Morris prices. Note the price consolidation from June to September with resistance around $51.50. The strong move above $51.50 in October produced a power box validating the breakout. The following is a candle volume chart of the British pound. You can see that this hybrid chart is similar to a candlestick chart, but the width of the bars vary based on volume. Technical analysis from A to Z. By Stephen B. Achelis. Fibonacci studies. Overview. Leonardo Fibonacci was a mathematician who was born in Italy around the year 1170. It is believed that Mr. Fibonacci discovered the relationship of what are now referred to as Fibonacci numbers while studying the Great Pyramid of Giza in Egypt. Fibonacci numbers are a sequence of numbers in which each successive number is the sum of the two previous numbers. 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 610, etc. These numbers possess an intriguing number of interrelationships, such as the fact that any given number is approximately 1.618 times the preceding number and any given number is approximately 0.618 times the following number. The booklet Understanding Fibonacci Numbers by Edward Dobson contains a good discussion of these interrelationships. Interpretation. There are four popular Fibonacci studies: arcs, fans, retracements, and time zones. The interpretation of these studies involves anticipating changes in trends as prices near the lines created by the Fibonacci studies. Arcs. Fibonacci arcs are displayed by first drawing a trend line between two extreme points, for example, a trough and opposing peak. Three arcs are then drawn, centered on the second extreme point, so they intersect the trend line at the Fibonacci levels of 38.2%, 50%, and 61.8%. The interpretation of Fibonacci arcs involves anticipating support and resistance as prices approach the arcs. A common technique is to display both Fibonacci arcs and Fibonacci fan lines and to anticipate support/resistance at the points where the Fibonacci studies cross. Note that the points where the arcs cross the price data will vary depending on the scaling of the chart, because the arcs are drawn so they are circular relative to the chart paper or computer screen. The following British pound chart illustrates how the arcs can provide support and resistance, points A, B, and C. Technical analysis from A to Z. By Stephen B. Achelis. Fans. Fibonacci fan lines are displayed by drawing a trend line between two extreme points. For example, a trough and opposing peak. Then an invisible vertical line is drawn. through the second extreme point. 3 trend lines are then drawn from the first extreme point, so they pass through the invisible vertical line at the Fibonacci levels of 38.2%, 50%, and 61.8%. This technique is similar to speed resistance lines. The following chart of Texaco shows how prices found support at the fan lines. You can see that when prices encountered the top fan line, point A, they were unable to penetrate the line for several days. When prices did penetrate this line, they dropped quickly to the bottom fan line, points B and C, before finding support. Also note that when prices bounced off the bottom line, point C, they rose freely to the top line. Point D, where they again met resistance, fell to the middle line, point E, and rebounded. Technical analysis from A to Z. By Stephen B. Achelis. Retracements. Fibonacci retracements are displayed by first drawing a trend line between two extreme points, for example, a trough and opposing peak. A series of 9 horizontal lines are drawn intersecting the trend line at the Fibonacci levels of 0%, 23.6%, 38.2%, 50%. 61.8%, 100%, 161.8%, 261.8%, and 423.6%. Some of the lines will probably not be visible because they will be off the scale. After a significant price move, either up or down, prices will often retrace a significant portion, if not all, of the original move. As prices retrace, support and resistance levels often occur at or near the Fibonacci retracement levels. In the following chart of Eastman Kodak, Fibonacci retracement lines were drawn between a major trough and peak. You can see that support and resistance occurred near the Fibonacci levels of 23 and 38%. Time zones. Fibonacci time zones are a series of vertical lines. They are spaced at the Fibonacci intervals of 1, 2, 3, 5, 8, 13, 21, 34, etc. The interpretation of Fibonacci time zones involves looking for significant changes in price near the vertical lines. In the following example, Fibonacci time zones were drawn on the Dow Jones Industrials beginning at the market bottom in 1970. Technical analysis from A to Z. By Stephen B. Achelis. You can see that significant changes in the industrials occurred on or near the time zone lines. 4% model. Overview. The 4% model is a stock market timing tool based on the percent change of the weekly close of the geometric value line composite index. It is a trend following tool designed to keep you in the market during major up moves and out, or short, during major down moves. The 4% model was developed by Ned Davis and popularized in Martin Zweig's book Winning on Wall Street. Interpretation. A significant strength of the 4% model is its simplicity. The model is easy to calculate and to analyze. In fact, only one piece of data is required: the weekly close of the value line composite index. A buy signal is generated when the index rises at least 4% from a previous value. A sell signal is generated when the index falls at least 4%. For example, a buy signal would be generated if the weekly close of the value line rose from 200 to 208. A 4% rise. If the index subsequently rallied to 250 and then dropped below 240. A 4% drop, a sell signal would be generated. From 1961 to 1992, a buy and hold approach on the value line index would have yielded 149 points, 3% annual return. Using the 4% model, including shorts, during the same period would have yielded 584 points, 13.6% annual return. Interestingly, about half of the signals generated were wrong. However, the average gain. Technical analysis from A to Z. By Stephen B. Achelis. Was much larger than the average loss, an excellent example of the stock market maxim. Cut your losses short and let your profits run. Example. The following chart shows the zigzag indicator plotted on top of the value line. Composite index. The zigzag indicator identifies changes in price that are at least 4%. Fourier transform. Overview. Fourier transforms were originally developed as an engineering tool to study repetitious phenomena such as the vibration of a stringed musical instrument or an airplane wing during flight. It is used in technical analysis to detect cyclical patterns within prices. It is beyond the scope of this book to provide a full explanation of Fourier analysis. Further information can be found in Technical Analysis of Stocks and Commodities. TASC, Volume 1 Issues Number 2, Number 4, and Number 7, Volume 2 Issue Number 4, Volume 3 Issues Number 2 and Number 7, Understanding Cycles, Volume 4 Issue Number 6, Volume 5 Issues Number 3, in Search of the Cause of Cycles, and Number 5, Cycles and Chart Patterns, and Volume 6 Issue Number 11, Cycles. The complete Fourier analysis concept is called spectral analysis. Fast Fourier transform, FFT, is an abbreviated calculation that can be computed in a fraction of the time. FFT sacrifices phase relationships and concentrates only on cycle length and amplitude. The benefit of FFT is its ability to extract the predominate cycle, S, from a series of data. Example: an indicator, or a security's price. Technical analysis from A to Z. By Stephen B. Achelis. FFTs are based on the principle that any finite, time-ordered set of data can be approximated by decomposing the data into a set of sine waves. Each sine wave has a specific cycle length, amplitude, and phase relationship to the other sine waves. A difficulty occurs when applying FFT analysis to security prices, because FFTs were designed to be applied to non-trending, periodic data. The fact that security prices are often trending is overcome by detrending the data using either a linear regression trend line or a moving average, to adjust for the fact that security data is not truly periodic. Since securities are not traded on weekends and some holidays, the prices are passed through a smoothing function called a Hamming window. Interpretation. As stated above, it is beyond the scope of this book to provide complete interpretation of FFT analysis. I will focus my discussion on the interpreted fast Fourier transforms found in the Metastock computer program. This indicator shows the three predominate cycle lengths and the relative strength of each of these cycles. The following chart displays the interpreted FFT of US Steel. The interpreted FFT shows that predominate cycle lengths in US Steel are 205, 39, and 27 trading days. The interpreted FFT indicator always displays the most significant cycle, 205 days in this example, on the left, and the least significant cycle, 27 days in this example, on the right. The length of each cycle is determined by the numeric value of the indicator, as read from the y-axis scales on the sides of the chart. The longer the indicator remains at a specific value, the more predominate it was in the data being analyzed. For example, in the above chart, the 205-day cycle is 5 times. Technical analysis from A to Z. By Stephen B. Achelis. Stronger than the 39-day cycle, because the indicator was at 205 for a much longer period. The fact that 205 is 5 times greater than 39 is coincidental. Once you know the predominate cycle length, you can use it as a parameter for other indicators. For example, if you know that a security has a 35-day cycle, you may want to Plot a 35-day moving average or a 35-day RSI on the security. Fundamental analysis. Overview. Fundamental analysis is the study of economic, industry, and company conditions in an effort to determine the value of a company's stock. Fundamental analysis typically focuses on key statistics in a company's financial statements to determine if the stock price is correctly valued. I realize that some people will find a discussion on fundamental analysis within a book on technical analysis peculiar, but the two theories are not as different as many people believe. It is quite popular to apply technical analysis to charts of fundamental data, for example, to compare trends in interest rates with changes in security prices. It is also popular to use fundamental analysis to select securities and then use technical analysis to time individual trades. Even die-hard technicians can benefit from an understanding of fundamental analysis, and vice versa. Interpretation. Most fundamental information focuses on economic, industry, and company statistics. The typical approach to analyzing a company involves 4 basic steps. 1. Determine the condition of the general economy. 2. Determine the condition of the industry. 3. Determine the condition of the company. 4. Determine the value of the company's stock. Economic analysis. The economy is studied to determine if overall conditions are good for the stock market. Is inflation a concern? Are interest rates likely to rise or fall? Are consumers spending? Is the trade balance favorable? Is the money supply expanding or contracting? These are just some of the questions that the fundamental analyst would ask to determine if economic conditions are right for the stock market. Technical Analysis from A to Z. By Stephen B. Achelis. Industry Analysis. The company's industry obviously influences the outlook for the company. Even the best stocks can post mediocre returns if they are in an industry that is struggling. It is often said that a weak stock in a strong industry is preferable to a strong stock in a weak industry. Company analysis. After determining the economic and industry conditions, the company itself is analyzed to determine its financial health. This is usually done by studying the company's financial statements. From these statements, a number of useful ratios can be calculated. The ratios fall under 5 main categories: profitability, price, liquidity, leverage, and efficiency. When performing ratio analysis on a company, the ratios should be compared to other companies within the same or similar industry to get a feel for what is considered normal. At least one popular ratio from each category is shown below. Net profit margin. A company's net profit margin is a profitability ratio calculated by dividing net income by total sales. This ratio indicates how much profit the company is able to squeeze out of each dollar of sales. For example, a net profit margin of 30% indicates that 30 cents of every $1 in sales is realized in profits. P/E ratio. The P/E ratio, i.e., price/earnings ratio, is a price ratio calculated by dividing the security's current stock price by the previous 4 quarters' earnings per share, EPS. The P/E ratio shows how much an investor must pay to buy $1 of the company's earnings. For example, if a stock's current price is $20 and the EPS for the last 4 quarters was $2, the P/E ratio is 10, i.e., $20/$2 equals 10. This means that you must pay $10 to buy $1 of the company's earnings. Of course, investor expectations of companies' future performance play a heavy role in determining a company's current P/E ratio. A common approach is to compare the P/E ratio of companies within the same industry. All else being equal, the company with the lower P/E ratio is the better value. Book value per share. A company's book value is a price ratio calculated by dividing total net assets, assets minus liabilities, by total shares outstanding. Depending on the accounting methods used and the age of the assets, book value can be helpful in determining if a security is overpriced or underpriced. If a security is selling at a price far below book value, it may be an indication that the security is underpriced. Current ratio. A company's current ratio is a liquidity ratio calculated by dividing current assets by current liabilities. This measures the company's ability to meet current debt obligations. The higher the ratio, the more liquid the company. For example, a current ratio of 3.0 means that the company's current assets, if liquidated, would be sufficient to pay for 3 times the company's current liabilities. Technical analysis from A to Z. By Stephen B. Achelis. Debt ratio. A company's debt ratio is a leverage ratio calculated by dividing total liabilities by total assets. This ratio measures the extent to which total assets have been financed with debt. For example, a debt ratio of 40% indicates that 40% of the company's assets have been financed with borrowed funds. Debt is a two-edged sword. During times of economic stress or rising interest rates, companies with a high debt ratio can experience financial problems. However, during good times, debt can enhance profitability by financing growth at a lower cost. Inventory turnover. A company's inventory turnover is an efficiency ratio calculated by dividing cost of goods sold by inventories. It reflects how effectively the company manages its inventories by showing the number of times per year inventories are turned over, replaced. Of course, this type of ratio is highly dependent on the industry. A grocery store chain will have a much higher turnover than a commercial airplane manufacturer. As stated previously, it is important to compare ratios with other companies in the same industry. Stock price valuation. After determining the condition and outlook of the economy, the industry, and the company, the fundamental analyst is prepared to determine if the company's stock is overvalued, undervalued, or correctly valued. Several valuation models have been developed to help determine the value of a stock. These include dividend models, which focus on the present value of expected dividends; earnings models, which focuses on the present value of expected earnings; and asset models, which focus on the value of the company's assets. There is no doubt that fundamental factors play a major role in a stock's price. However, if you form your price expectations based on fundamental factors, it is important that you study the price history as well, or you may end up owning an undervalued stock that remains undervalued. Gann angles. Overview. W. D. Gann, 1878 to 1955, designed several unique techniques for studying price charts. Central to Gann's techniques was geometric angles in conjunction with time and price. Gann believed that specific geometric patterns and angles had unique characteristics that could be used to predict price action. All of Gann's techniques require that equal time and price intervals be used on the charts, so that a rise/run of 1x1 will always equal a 45-degree angle. Technical analysis from A to Z. By Stephen B. Achelis. Interpretation. Gann believed that the ideal balance between time and price exists when prices rise or fall at a 45-degree angle relative to the time axis. This is also called a 1x1 angle, i.e., prices rise one price unit for each time unit. Gann angles are drawn between a significant bottom and top, or vice versa, at various angles. Deemed the most important by Gann, the 1x1 trend line signifies a bull market if prices are above the trend line, or a bear market if below. Gann felt that a 1x1 trend line Provides major support during an uptrend, and when the trend line is broken, it signifies a major reversal in the trend. Gann identified 9 significant angles, with the 1x1 being the most important. 1x8, 82.5 degrees. 1x4, 75 degrees. 1x3, 71.25 degrees. 1x2, 63.75 degrees. 1x1, 45 degrees. 2x1, 26.25 degrees. 3x1, 18.75 degrees. 4x1, 15 degrees. 8x1, 7.5 degrees. Note that in order for the rise/run values, example 1x1, 1x8, etc., to match the actual angles in degrees, the x and y axes must have equally spaced intervals. This means that one unit on the x-axis, i.e., hour, day, week, month, etc., must be the same distance as one unit on the y-axis. The easiest way to calibrate the chart is make sure that a 1x1 angle produces a 45-degree angle. Gann observed that each of the angles can provide support and resistance depending on the trend. For example, during an uptrend the 1x1 angle tends to provide major support. A major reversal is signaled when prices fall below the 1x1 angled trend line. According to Gann, prices should then be expected to fall to the next trend line, i.e., the 2x1 angle. In other words, as one angle is penetrated, expect prices to move and consolidate at the next angle. Gann developed several techniques for studying market action. These include Gann angles, Gann fans, Gann grids, and cardinal squares. Technical analysis from A to Z. By Stephen B. Achelis. Example. A Gann fan displays lines at each of the angles that Gann identified. The following chart shows a Gann fan on the S&P 500. You can see that the S&P bounced off the 1x1 and 2x1 lines. This next chart shows the same S&P 500 data with a Gann grid. This is an 80x80 grid, each line on the grid is 1x1 and the lines are spaced 80 weeks apart. Technical analysis from A to Z. By Stephen B. Achelis. Herrick Payoff Index. Overview. The Herrick Payoff Index is designed to show the amount of money flowing into or out of a futures contract. The index uses open interest during its calculations, therefore, the security being analyzed must contain open interest. The Herrick Payoff Index was developed by John Herrick. Interpretation. When the Herrick Payoff Index is above zero, it shows that money is flowing into the futures contract, which is bullish. When the index is below zero, it shows that money is flowing out of the futures contract, which is bearish. The interpretation of the Herrick Payoff Index involves looking for divergences between the index and prices. Example. The following chart shows the British pound and the Herrick Payoff Index. The trend lines identify a bearish divergence where prices were making new highs while the payoff index was failing to make new highs. As is typical with divergences, prices corrected to confirm the indicator. Technical analysis from A to Z. By Stephen B. Achelis. Calculation. The Herrick Payoff Index requires two inputs, a smoothing factor known as the multiplying factor and the value of a 1-cent move. The multiplying factor is part of a smoothing mechanism. The results are similar to the smoothing obtained by a moving average. For example, a multiplying factor of 10 produces results similar to a 10-period moving average. Mr. Herrick recommends 100 as the value of a 1-cent move for all commodities, except silver, which should be 50. The calculation of the Herrick Payoff Index, HPI, is where Technical Analysis from A to Z. By Stephen B. Achelis. Interest rates. Overview. Interest rates play a key role in the general business cycle and the financial markets. When interest rates change, or interest rate expectations change, the effects are far-reaching. When rates rise, consumers spend less, which causes retail sales to slow, which leads to reduced corporate profits, a declining stock market, and higher unemployment. The effect of declining corporate profits on the stock market is compounded by the fact that higher interest rates make interest-bearing investments more attractive, causing an exodus of money from the stock market. Interpretation. Historically, an increase in interest rates is bearish for the stock market, whereas a decrease is bullish. The following chart shows the 4-month rate of change of the prime rate and the Dow Industrials. I drew by arrows when interest rates were falling, the indicator was below 0, and sell arrows when rates were rising. The arrows show the strong correlation between interest rates and the stock market. Corporate bond rates. Just as governments issue bonds to fund their activities, so do corporations. Corporate bonds are considered riskier than treasury bonds and compensate for their higher risk with higher yields. The yield of a specific corporate bond depends on numerous factors. The most important is the financial health of the corporation and prevailing interest rates. Several bond rating services provide investors with an evaluation to help judge the bond's quality. Technical Analysis from A to Z. By Stephen B. Achelis. The Confidence Index, developed by Barron's in 1932, uses corporate bond yields as one of its components. The Confidence Index attempts to measure the confidence that investors have in the economy by comparing high-grade bond yields to speculative-grade bond yields. If investors are optimistic about the economy, they are more likely to invest in speculative bonds, thereby driving speculative bond yields down, and the confidence index up. On the other hand, if they are pessimistic about the economy, they are more likely to move their money from speculative grade bonds to conservative high-grade bonds, thereby driving high-grade bond yields down and the confidence index down. Discount rate. The discount rate is the interest rate that the Federal Reserve charges member banks for loans. Banks use the discount rate as the base for loans made to their customers. The discount rate is set by the Federal Reserve Board, which consists of 7 members, appointed by the President of the United States. The discount rate does not fluctuate on a day-to-day basis like most other interest rates. Instead, it only changes when the Federal Reserve Board feels it is necessary to influence the economy. During recessionary times, the Fed will ease interest rates to promote borrowing and spending. During inflationary times, the Fed will raise interest rates to discourage borrowing and spending, thereby slowing the rise in prices. Federal funds. Banks with excess reserves can lend their reserves to banks with deficient reserves at the federal funds market. The interest rate charged for these short, often just overnight loans is called the Fed funds rate. Prime rate. The prime rate is the interest rate U.S. banks charge their best corporate clients. Changes in the prime rate are almost always on the heels of a change in the discount rate. Treasury bond rates. An extremely important interest rate is the yield on 30-year Treasury bonds, long bonds. The U.S. Treasury Department auctions these bonds every 6 months. Long bonds are the most volatile of all government bonds, because of the length of their maturities. A small change in interest rates causes an amplified change in the underlying bonds price. Technical Analysis from A to Z. By Stephen B. Achelis. Treasury bill rates. Treasury bills are short-term, 13 and 26-week, money market instruments. They are auctioned by the U.S. Treasury Department weekly and are often used as a secure place to earn current market rates. Example. The following chart shows several interest rates side by side. KAGI. Overview. KAGI charts are believed to have been created around the time that the Japanese stock market began trading in the 1870s. KAGI charts display a series of connecting vertical lines where the thickness and direction of the lines are dependent on the price action. The charts ignore the passage of time. If prices continue to move in the same direction, the vertical line is extended. However, if prices reverse by a reversal amount, a new KAGI line is then drawn in a new column. When prices penetrate a previous high or low, the thickness of the KAGI line changes. KAGI charts were brought to the United States by Stephen Nizan when he published the book, Beyond Candlesticks. Interpretation. KAGI charts illustrate the forces of supply and demand on a security. Technical analysis from A to Z. By Stephen B. Achelis. A series of thick lines shows that demand is exceeding supply, a rally. A series of thin lines shows that supply is exceeding demand, a decline. Alternating thick and thin lines shows that the market is in a state of equilibrium, i.e., supply equals demand. The most basic trading technique for KAGI charts is to buy when the KAGI line changes from thin to thick and to sell when the KAGI line changes from thick to thin. A sequence of higher highs and higher lows on a KAGI chart shows the underlying forces are bullish, whereas lower highs and lower lows indicate underlying weakness. Example. The following chart shows a 0.02 point KAGI chart and a classic bar chart of euro-dollars. I drew by arrows on the bar chart when the KAGI lines changed from thin to thick and drew sell arrows when the lines changed from thick to thin. Calculation. The first closing price in a KAGI chart is the starting price. To draw the first KAGI line, today's close is compared to the starting price. If today's price is greater than or equal to the starting price, then a thick line is drawn from the starting price to the new closing price. If today's price is less than or equal to the starting price, then a thin line is drawn from the starting price to the new closing price. Technical analysis from A to Z. By Stephen B. Achelis. To draw subsequent lines, compare the closing price to the tip, i.e. bottom or top, of the previous KAGI line. If the price continued in the same direction as the previous line, the line is extended in the same direction, no matter how small the move. If the price moved in the opposite direction by at least the reversal amount, this may take several days, then a short horizontal line is drawn to the next column, and a new vertical line is drawn to the closing price. If the price moved in the opposite direction of the current column by less than the reversal amount, no lines are drawn. If a thin KAGI line exceeds the prior high point on the chart, the line becomes thick. Likewise, if a thick KAGI line falls below the prior low point, the line becomes thin. Large block ratio. Overview. This market sentiment indicator shows the relationship between large block trades, which are trades of more than 10,000 shares, and the total volume on the New York Stock Exchange. The comparison of large block trades to total volume shows how active the large institutional traders are. The higher the large block ratio, the more institutional activity is taking place. To smooth out the day-to-day fluctuations, I recommend plotting a 20-day moving average of the large block ratio. Interpretation. A high number of large block trades in relation to total volume often coincides with market tops and bottoms. This occurs as institutions recognize the extreme overbought or oversold conditions of the market and place trades accordingly. Of course, this assumes the institutions know what they are doing. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows the New York Stock Exchange Index and the large block ratio. I drew vertical lines when the ratio was relatively high. You can see that these points coincided with intermediate term peaks. Calculation. The large block ratio is calculated by dividing the number of large block trades by the total volume on the New York Stock Exchange. Linear regression lines. Overview. Linear regression is a statistical tool used to predict future values from past values. In the case of security prices, it is commonly used to determine when prices are overextended. A linear regression trend line uses the least squares method to plot a straight line through prices so as to minimize the distances between the prices and the resulting trend line. Interpretation. If you had to guess what a particular security's price would be tomorrow, a logical guess would be fairly close to today's price. If prices are trending up, a better guess might be. Technical Analysis from A to Z. By Stephen B. Achelis. Fairly close to today's price with an upward bias. Linear regression analysis is the statistical confirmation of these logical assumptions. A linear regression trend line is simply a trend line drawn between 2 points using the least squares fit method. The trend line is displayed in the exact middle of the prices. If you think of this trend line as the equilibrium price, any move above or below the trend line indicates overzealous buyers or sellers. A popular method of using the linear regression trend line is to construct linear regression channel lines. Developed by Gilbert Raff, the channel is constructed by plotting two parallel, equidistant lines above and below a linear regression trend line. The distance between the channel lines to the regression line is the greatest distance that any one closing price is from the regression line. Regression channels contain price movement, with the bottom channel line providing support and the top channel line providing resistance. Prices may extend outside of the channel for a short period of time. However, if prices remain outside the channel for a longer period of time, a reversal in trend may be imminent. A linear regression trend line shows where equilibrium exists. Linear regression channels show the range prices can be expected to deviate from a linear regression trend line. The time series forecast indicator displays the same information as a linear regression trend line. Any point along the time series forecast is equal to the ending value of a linear regression trend line. For example, the ending value of a linear regression trend line that covers 10 days will have the same value as a 10-day time series forecast. Example. The following chart shows the Japanese yen with a linear regression channel. Technical Analysis from A to Z. By Stephen B. Achelis. Calculation. The linear regression formula is where MACD. Overview. The MACD, moving average convergence/divergence, is a trend following momentum indicator that shows the relationship between two moving averages of prices. The MACD was developed by Gerald Appel, publisher of Systems and Forecasts. The MACD is the difference between a 26-day and 12-day exponential moving average. A 9-day exponential moving average, called the signal, or trigger, line is plotted on top of the MACD to show buy/sell opportunities. Appel specifies exponential moving averages as percentages. Thus, he refers to these three moving averages as 7.5%, 15%, and 20% respectively. Interpretation. The MACD proves most effective in wide-swinging trading markets. There are three popular ways to use the MACD: crossovers, overbought/oversold conditions, and divergences. Crossovers. The basic MACD trading rule is to sell when the MACD falls below its signal line. Similarly, a buy signal occurs when the MACD rises above its signal line. It is also popular to buy/sell when the MACD goes above/below zero. Technical Analysis from A to Z. By Stephen B. Achelis. Overbought/oversold conditions. The MACD is also useful as an overbought/oversold indicator. When the shorter moving average pulls away dramatically from the longer moving average, i.e., the MACD rises, it is likely that the security price is overextending and will soon return to more realistic levels. MACD overbought and oversold conditions vary from security to security. Divergences. A indication that an end to the current trend may be near occurs when the MACD diverges from the security. A bearish divergence occurs when the MACD is making new lows while prices fail to reach new lows. A bullish divergence occurs when the MACD is making new highs while prices fail to reach new highs. Both of these divergences are most significant when they occur at relatively overbought/oversold levels. Example. The following chart shows Whirlpool and its MACD. I drew buy arrows when the MACD rose above its signal line and drew sell when the MACD fell below its signal line. This chart shows that the MACD is truly a trend following indicator sacrificing early signals in exchange for keeping you on the right side of the market. When a significant trend developed, such as in October 1993 and beginning in February 1994, the MACD was able to capture the majority of the move. When the trend was short-lived, such as in January 1993, the MACD proved unprofitable. Technical Analysis from A to Z. By Stephen B. Achelis. Calculation. The MACD is calculated by subtracting the value of a 26-day exponential moving average from a 12-day exponential moving average. A 9-day dotted exponential moving average of the MACD, the signal line, is then plotted on top of the MACD. Mass Index. Overview. The Mass Index was designed to identify trend reversals by measuring the narrowing and widening of the range between the high and low prices. As this range widens, the Mass Index increases; as the range narrows, the Mass Index decreases. The Mass Index was developed by Donald Dorsey. Interpretation. According to Mr. Dorsey, the most significant pattern to watch for is a reversal bulge. A reversal bulge occurs when a 25-period mass index rises above 27.0 and subsequently falls below 26.5. A reversal in price is then likely. The overall price trend, i.e., trending or trading range, is unimportant. A 9-period exponential moving average of prices is often used to determine whether the reversal bulge indicates a buy or sell signal. When the reversal bulge occurs, you should buy if the moving average is trending down, in anticipation of the reversal, and sell if it is trending up. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows Litton and its mass index. A 9-day exponential moving average is plotted on top of Litton's prices. I drew arrows when a reversal bulge occurred, i.e., the mass index rose above 27 and then fell below 26.5. If the 9-day moving average was falling, I drew a buy arrow. If the 9-day moving average was rising, I drew a sell arrow. You can see that the signals generated by the mass index during this time period occurred a few days before the trend reversed. Calculation. 1. Calculate a 9-day exponential moving average, EMA, of the difference between the high and low prices. 2. Calculate a 9-day exponential moving average of the moving average calculated in Step 1. 3. Divide the moving average calculated in Step 1 by the moving average calculated in Step 2. 4. Total the values in Step 3 for the number of periods in the mass index, example 25 days. Technical Analysis from A to Z. By Stephen B. Achelis. McClellan Oscillator. Overview. The McClellan Oscillator is a market breadth indicator that is based on the smoothed Difference between the number of advancing and declining issues on the New York Stock Exchange. The McClellan oscillator was developed by Sherman and Marion McClellan. Extensive coverage of the oscillator is provided in their book Patterns for Profit. Interpretation. Indicators that use advancing and declining issues to determine the amount of participation in the movement of the stock market are called breadth indicators. A healthy bull market is accompanied by a large number of stocks making moderate upward advances in price. A weakening bull market is characterized by a small number of stocks making large advances in price, giving the false appearance that all is well. This type of divergence often signals an end to the bull market. A similar interpretation applies to market bottoms, where the market index continues to decline while fewer stocks are declining. The McClellan oscillator is one of the most popular breadth indicators. Another popular breadth indicator is the advance/decline line. Buy signals are typically generated when the McClellan oscillator falls into the oversold area of -70 to -100 and then turns up. Sell signals are generated when the oscillator rises into the overbought area of +70 to +100 and then turns down. If the oscillator goes beyond these areas, i.e., rises above +100 or falls below -100, it is a sign of an extremely overbought or oversold condition. These extreme readings are usually a sign of a continuation of the current trend. For example, if the oscillator falls to -90 and turns up, a buy signal is generated. However, if the oscillator falls below -100, the market will probably trend lower during the next 2 or 3 weeks. You should postpone buying until the oscillator makes a series of rising bottoms or the market regains strength. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following chart illustrates the 5 trading zones of the McClellan oscillator, i.e. above +100, between +70 and +100, between +70 and -70, between -70 and -100, and below -100. This next chart shows the McClellan oscillator and the Dow Industrials. Drew buy arrows when the oscillator rose above -70 and sell arrows when the oscillator fell below +70. This indicator does an excellent job of timing entry and exit points. Technical Analysis from A to Z. By Stephen B. Achelis. Calculation. The McClellan oscillator is the difference between 10%, approximately 19-day, and 5%, approximately 39-day, exponential moving averages of advancing minus declining issues. McClellan Summation Index. Overview. The McClellan Summation Index is a market breadth indicator based on the McClellan oscillator. The McClellan Summation Index was developed by Sherman and Marion McClellan. Extensive coverage of the index is provided in their book Patterns for Profit. Interpretation. The McClellan Summation Index is a long-term version of the McClellan oscillator. Its interpretation is similar to that of the McClellan oscillator except that it is more suited to major trend reversals. As explained in the calculation section, there are 2 methods to calculate the summation index. The 2 calculation methods create indicators with identical appearances, but their numeric values differ. These interpretational comments refer to the suggested calculation method explained in the calculation section. McClellan suggests the following rules for use with the summation index. Look for major bottoms when the summation index falls below -1,300. Look for major tops to occur when a divergence, page 29, with the market occurs above a summation index level of +1,600. The beginning of a significant bull market is indicated when the summation index crosses above +1,900 after moving upward more than 3,600 points from its prior low, Example: the index moves from -1,600 to +2,000. Technical analysis from A to Z. By Stephen B. Achelis. Example: the following chart shows the McClellan Summation Index and the New York Stock Exchange Index. At the point labeled A, the Summation Index fell below -1,300. This signified a major bottom. The point labeled B indicated the beginning of a significant bull market. Because the Summation Index rose above +1,900 after moving upward more than 3,600 points from its prior low. Calculation. The McClellan Summation Index can be calculated using two different methods. This first method is the suggested method promoted by Mr. McClellan. It subtracts 10%, approximately 19-day, and 5%, approximately 39-day, exponential moving averages of advancing minus declining issues from the McClellan oscillator. Where the second method is to calculate a cumulative sum of the McClellan oscillator values. Technical analysis from A to Z. By Stephen B. Achelis. Median price. Overview. The median price indicator is simply the midpoint of each day's price. The typical price and weighted close are similar indicators. Interpretation. The median price indicator provides a simple, single-line chart of the day's average price. This average price is useful when you want a simpler view of prices. Example: the following chart shows the median price indicator, dotted line, on top of KeyCorp's bar chart. Calculation. The median price indicator is calculated by adding the high and low price and dividing by 2. Technical analysis from A to Z. By Stephen B. Achelis. Member short ratio. Overview. The member short ratio, MSR, is a market sentiment indicator that measures the short selling activity of members of the New York Stock Exchange. Members trade on the floor of the exchange either for their own account or for their clients. Stocks are sold short in anticipation of the price falling. Knowing what the smart money is doing, example members, is often a good indication of the near-term market direction. The MSR is the inverse of the public short ratio. This is because there are only two players in the market, the public and the members. Members are further divided into specialists and others. When the public short ratio is 20%, the member short ratio must be 80%. Interpretation. Because the MSR is the inverse of the PSR, interpretation of the MSR is the opposite of the PSR. When the members are short, a high MSR, you should be short, and when the members are long, a low MSR, you should be long. For more information on interpreting the MSR, refer to the discussion on the public short ratio. Calculation. The member short ratio is calculated by dividing the number of member shorts, defined as total short sales minus public short sales, by the total number of short sales. The resulting figure shows the percentage of shorts that were made by members of the New York Stock Exchange. Technical analysis from A to Z. By Stephen B. Achelis. Momentum. Overview. The momentum indicator measures the amount that a security's price has changed over a given time span. Interpretation. The interpretation of the momentum indicator is identical to the interpretation of the price rock. Both indicators display the rate of change of a security's price. However, the price rock indicator displays the rate of change as a percentage, whereas the momentum indicator displays the rate of change as a ratio. There are basically two ways to use the momentum indicator. You can use the momentum indicator as a trend following oscillator similar to the MACD. This is the method I prefer. Buy when the indicator bottoms and turns up, and sell when the indicator peaks and turns down. You may want to plot a short-term, Example 9 period, moving average of the indicator to determine when it is bottoming or peaking. If the momentum indicator reaches extremely high or low values, relative to its historical values, you should assume a continuation of the current trend. 4. Example, if the momentum indicator reaches extremely high values and then turns down, you should assume prices will probably go still higher. In either case, only trade after prices confirm the signal generated by the indicator. Example, if prices peak and turn down, wait for prices to begin to fall before selling. You can also use the momentum indicator as a leading indicator. This method assumes that market tops are typically identified by a rapid price increase, when everyone expects prices to go higher, and that market bottoms typically end with rapid price declines, when everyone wants to get out. This is often the case, but it is also a broad generalization. As a market peaks, the momentum indicator will climb sharply and then fall off, diverging from the continued upward or sideways movement of the price. Similarly, at a market bottom, momentum will drop sharply and then begin to climb well ahead of prices. Both of these situations result in divergences between the indicator and prices. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows integrated circuits and its 12-day momentum indicator. Divergences at points A and B provided leading indications of the reversals that followed. Money Flow Index. Overview. The Money Flow Index, MFI, is a momentum indicator that measures the strength of money flowing in and out of a security. It is related to the Relative Strength Index, but where the RSI only incorporates prices, the Money Flow Index accounts for volume. Interpretation. The interpretation of the Money Flow Index is as follows. Look for divergence between the indicator and the price action. If the price trends higher and the MFI trends lower, or vice versa, a reversal may be imminent. Look for market tops to occur when the MFI is above 80. Look for market bottoms to occur when the MFI is below 20. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows Intel and its 14-day money flow index. Divergences at points A and B provided leading indications of the reversals that followed. Calculation. The money flow index requires a series of calculations. First, the period's typical price is calculated. Next, money flow, not the money flow index, is calculated by multiplying the period's typical price by the volume. If today's typical price is greater than yesterday's typical price, it is considered positive money flow. If today's price is less, it is considered negative money flow. Positive money flow is the sum of the positive money over the specified number of periods. Negative money flow is the sum of the negative money over the specified number of periods. Technical analysis from A to Z. By Stephen B. Achelis. The money ratio is then calculated by dividing the positive money flow by the negative money flow. Finally, the money flow index is calculated using the money ratio. Moving averages. Overview. A moving average is an indicator that shows the average value of a security's price over a period of time. When calculating a moving average, a mathematical analysis of the security's average value over a predetermined time period is made. As the security's price changes, its average price moves up or down. There are 5 popular types of moving averages: simple, also referred to as arithmetic; exponential, triangular, variable, and weighted. Moving averages can be calculated on any data series including a security's open, high, low, close, volume, or another indicator. A moving average of another moving average is also common. The only significant difference between the various types of moving averages is the weight assigned to the most recent data. Simple moving averages apply equal weight to the prices. Exponential and weighted averages apply more weight to recent prices. Triangular averages apply more weight to prices in the middle of the time period. And variable moving averages change the weighting based on the volatility of prices. Interpretation. The most popular method of interpreting a moving average is to compare the relationship between a moving average of the securities price with the securities price itself. A buy signal is generated when the securities price rises above its moving average, and a sell signal is generated when the securities price falls below its moving average. Technical analysis from A to Z. By Stephen B. Achelis. The following chart shows the Dow Jones Industrial Average, DJIA, from 1970 through 1993. Also displayed is a 15-month simple moving average. Buy arrows were drawn when the DJIA's close rose above its moving average, sell arrows were drawn when it closed below its moving average. This type of moving average trading system is not intended to get you in at the exact bottom nor out at the exact top. Rather, it is designed to keep you in line with the securities price trend by buying shortly after the securities price bottoms and selling shortly after it tops. The critical element in a moving average is the number of time periods used in calculating the average. When using hindsight, you can always find a moving average that would have been profitable. Using a computer, I found that the optimum number of months in the preceding chart would have been 43. The key is to find a moving average that will be consistently profitable. The most popular moving average is the 39-week, or 200-day, moving average. This moving average has an excellent track record in timing the major, long-term, market cycles. The length of a moving average should fit the market cycle you wish to follow. For example, if you determine that a security has a 40-day peak-to-peak cycle, the ideal moving average length would be 21 days, calculated using the following formula. Technical analysis from A to Z. By Stephen B. Achelis. Table 7. Trend. Moving average. Very short term. 5 to 13 days. Short term. 14 to 25 days. Minor intermediate 26 to 49 days. Intermediate. 50 to 100 days. Long term. 100 to 200 days. You can convert a daily moving average quantity into a weekly moving average quantity by dividing the number of days by 5. Example, a 200-day moving average is almost identical to a 40-week moving average. To convert a daily moving average quantity into a monthly quantity, divide the number of days by 21. Example, a 200-day moving average is very similar to a 9-month moving average, because there are approximately 21 trading days in a month. Moving averages can also be calculated and plotted on indicators. The interpretation of an indicator's moving average is similar to the interpretation of a security's moving average. When the indicator rises above its moving average, it signifies a continued upward movement by the indicator. When the indicator falls below its moving average, it signifies a continued downward movement by the indicator. Indicators which are especially well suited for use with moving average penetration systems include the MACD, price rock, momentum, and stochastics. Some indicators, such as short-term stochastics, fluctuate so erratically that it is difficult to tell what their trend really is. By erasing the indicator and then plotting a moving average of the indicator, you can see the general trend of the indicator rather than its day-to-day fluctuations. Whipsaws can be reduced, at the expense of slightly later signals, by plotting a short-term moving average, example 2 to 10 day, of oscillating indicators such as the 12-day rock. stochastics, or the RSI. For example, rather than selling when the stochastic oscillator falls below 80, you might sell only when a 5-period moving average of the stochastic oscillator falls below 80. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows Lincoln National and its 39-week exponential moving average. Although the moving average does not pinpoint the tops and bottoms perfectly, it does provide a good indication of the direction prices are trending. Calculation. The following sections explain how to calculate moving averages of a security's price using the various calculation techniques. Simple. A simple, or arithmetic, moving average is calculated by adding the closing price of the security for a number of time periods, example 12 days, and then dividing this total by the number of time periods. The result is the average price of the security over the time period. Simple moving averages give equal weight to each daily price. For example, to calculate a 21-day moving average of IBM, first, you would add IBM's closing prices for the most recent 21 days. Next, you would divide that sum by 21, this would give you the average price of IBM over the preceding 21 days. You would plot this average price on the chart. You would perform the same calculation tomorrow, add up the previous 21 days closing prices, divide by 21, and plot the resulting figure on the chart. Technical Analysis from A to Z. By Stephen B. Achelis. Where exponential. An exponential, or exponentially weighted, moving average is calculated by applying a percentage of today's closing price to yesterday's moving average value. Exponential moving averages place more weight on recent prices. For example, to calculate a 9% exponential moving average of IBM, you would first take today's closing price and multiply it by 9%. Next, you would add this product to the value of yesterday's moving average multiplied by 91%, 100%, 9% equals 91%. Because most investors feel more comfortable working with time periods, rather than with percentages, the exponential percentage can be converted into an approximate number of days. For example, a 9% moving average is equal to a 21.2 time period. Rounded to 21, exponential moving average. The formula for converting exponential percentages to time periods is: you can use the above formula to determine that a 9% moving average is equivalent to a 21-day exponential moving average. The formula for converting time periods to exponential percentages is: you can use the above formula to determine that a 21-day exponential moving average is actually a 9% moving average. Technical Analysis from A to Z. By Stephen B. Achelis. Triangular. Triangular moving averages place the majority of the weight on the middle portion of the price series. They are actually double-smoothed simple moving averages. The periods used in the simple moving averages varies depending on if you specify an odd or even number of time periods. The following steps explain how to calculate a 12-period triangular moving average. 1. Add 1 to the number of periods in the moving average, example 12 plus 1 is 13. 2. Divide the sum from step number 1 by 2, example 13 divided by 2 is 6.5. 3. If the result of step number 2 contains a fractional portion, round the result up to the nearest integer, example round 6.5 up to 7. 4. Using the value from step number 3, i.e., 7, calculate a simple moving average of the closing prices, i.e., a 7-period simple moving average. 5. Again using the value from step number 3, i.e., 7, calculate a simple moving average of the moving average calculated in step number 4, i.e., a moving average of a moving average. Variable. A variable moving average is an exponential moving average that automatically adjusts the smoothing percentage based on the volatility of the data series. The more volatile the data, the more sensitive the smoothing constant used in the moving average calculation. Sensitivity is increased by giving more weight given to the current data. Most moving average calculation methods are unable to compensate for trading range versus trending markets. During trading ranges, when prices move sideways in a narrow range, shorter-term moving averages tend to produce numerous false signals. In trending markets, when prices move up or down over an extended period, longer-term moving averages are slow to react to reversals in trend. By automatically adjusting the smoothing constant, a variable moving average is able to adjust its sensitivity, allowing it to perform better in both types of markets. A variable moving average is calculated as follows. Where? Technical analysis from A to Z. By Stephen B. Achelis. Different indicators have been used for the volatility ratio. I use a ratio of the VHF indicator compared to the VHF indicator 12 periods ago. The higher this ratio, the trendier the market, thereby increasing the sensitivity of the moving average. The variable moving average was defined by Tushar Chanda in an article that appeared in Technical Analysis of Stocks and Commodities in March, 1992. Weighted. A weighted moving average is designed to put more weight on recent data and less weight on past data. A weighted moving average is calculated by multiplying each of the previous day's data by a weight. The following table shows the calculation of a 5-day weighted moving average. Table 8. 5-day weighted moving average. Day hashtag. Weight. 1. 1. Asterisk 25.00. Equals 25.00. 2. 2. Asterisk 26.00. Equals 52.00. 3. 3. Asterisk 28.00. Equals 84.00. 4. 4. Asterisk 25.00. Equals 100.00. 5. 5. Asterisk 29.00. Equals 145.00. Totals, 15. Price. Weighted. Asterisk 133.00 equals 406.00. Average. Slash 15 equals 27.067. The weight is based on the number of days in the moving average. In the above example, the weight on the first day is 1.0 while the value on the most recent day is 5.0. This gives 5 times more weight to today's price than the price 5 days ago. Technical Analysis from A to Z. By Stephen B. Achelis. The following chart displays 25-day moving averages using the simple, exponential, weighted, triangular, and variable methods of calculation. Negative Volume Index. Overview. The Negative Volume Index, NVI, focuses on days where the volume decreases from the previous day. The premise being that the smart money takes positions on days when volume decreases. Interpretation. The interpretation of the NVI assumes that on days when volume increases, the crowd following uninformed investors are in the market. Conversely, on days with decreased volume, the smart money is quietly taking positions. Thus, the NVI displays what the smart money is doing. In stock market logic, Norman Fosbach points out that the odds of a bull market are 95 out of 100 when the NVI rises above its one-year moving average. The odds of a bull market are roughly 50/50ths when the NVI is below its one-year average. Therefore, the NVI is most usefully as a bull market indicator. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows Avon and its NVI. I drew by arrows whenever the NVI crossed above its 1 year, 255 trading day, moving average. I drew equal signs when the NVI fell below the moving average. You can see that the NVI did a great job of identifying profitable opportunities. Calculation. If today's volume is less than yesterday's volume, then if today's volume is greater than or equal to yesterday's volume, then because falling prices are usually associated with falling volume, the NVI usually trends downward. New highs lows cumulative. Overview. The new highs lows cumulative indicator is a long-term market momentum indicator. It is a cumulative total of the difference between the number of stocks reaching new 52-week highs and the number of stocks reaching new 52-week lows. Technical analysis from A to Z. By Stephen B. Achelis. Interpretation. The new high-low cumulative indicator provides a confirmation of the current trend. Most of the time, the indicator will move in the same direction as major market indices. However, when the indicator and market move in opposite directions, it is likely that the market will reverse. The interpretation of the new highs-lows cumulative indicator is similar to the advance/decline line in that divergences occur when the indicator fails to confirm the market index's high or low. Divergences during an uptrending market indicate potential weakness, while divergences in a downtrending market indicate potential strength. Example. The following chart shows the S&P 500 and the new highs-lows cumulative indicator. A classic divergence occurred during 1985 and 1986 where the S&P 500 index was making new highs, but the new highs-lows cumulative indicator was failing to surpass its previous highs. This was followed by the crash of 1987. Calculation. The new highs-lows cumulative indicator is simply a cumulative total of the number of stocks making new 52-week highs minus the number of stocks making new 52-week lows. Technical analysis from A to Z. By Stephen B. Achelis. New highs, new lows. Overview. The new highs, new lows indicator, NHNL, displays the daily difference between the number of stocks reaching new 52-week highs and the number of stocks reaching new 52-week lows. Interpretation. You can interpret the NHNL indicator as a divergence indicator or as an oscillator. I usually plot a 10-day moving average of the NHNL indicator to smooth the daily values. Divergence. The NHNL indicator generally reaches its extreme lows slightly before a major market bottom. As the market then turns up from the major bottom, the indicator jumps up rapidly. During this period, many new stocks are making new highs because it's easy to make a new high when prices have been depressed for a long time. As the cycle matures, a divergence often occurs as fewer and fewer stocks are making new highs, the indicator falls, yet the market indices continue to reach new highs. This is a classic bearish divergence that indicates that the current upward trend is weak and may reverse. Oscillator. The NHNL indicator oscillates around 0. If the indicator is positive, the bulls are in control. If it is negative, the bears are in control. You can trade the NHNL indicator by buying and selling as the indicators passes through 0. This won't always keep you on the right side of the market, but it is helpful to confirm the current trend. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows the S&P 500 and a 10-day moving average of the NHNL indicator. I used the NHNL indicator to confirm a traditional moving average trading system. I drew by arrows when the S&P 500 rose above its 50-day moving average, but only if the 10-day moving average of the NHNL indicator was above 0. I drew sell arrows. Anytime the S&P 500 fell below its moving average. By ignoring buy signals unless the 10-day moving average of the NHNL indicator was above zero, I reduced the number of trades by 50% and increased profits by 9%. Calculation. The new highs new lows is calculated by simply taking the difference between the number of stocks that made new 52-week highs and the number of stocks that made new 52-week lows. I usually plot a 10-day moving average of this value. New highs/lows ratio. Overview. The new highs/lows ratio, NH/NL ratio, displays the daily ratio between the number of stocks reaching new 52-week highs and the number of stocks reaching new 52-week lows. Technical Analysis from A to Z. By Stephen B. Achelis. Interpretation. The NH/NL ratio is another useful method to visualize the relationship of stocks that are making new highs and new lows. High readings indicate that a large number of stocks are making new highs, compared to the number of stocks making new lows. Readings less than 1 indicate that the number of stocks making new highs are less than the number of stocks making lows. Refer to the new highs new lows indicator for more information on interpreting the NH/NL ratio. Example. The following chart shows the S&P 500 and the NH/NL ratio. The ratio increased dramatically when the S&P 500 began making new highs in 1990. However, as the S&P has continued to move on to new highs, the ratio has failed to reach new highs. This implies that the S&P 500 is weaker than it appears. Calculation. Technical Analysis from A to Z. By Stephen B. Achelis. Odd Lot Balance Index. Overview. The Odd Lot Balance Index, OLBI, is a market sentiment indicator that shows the ratio of odd lot sales to purchases. An odd lot is a stock transaction of less than 100 shares. The assumption is that the odd lotters, the market's smallest traders, don't know what they are doing. Unfortunately, the trading of 99 share lots in an effort to skirt the uptick rule, which requires that specialists take short positions only when prices move upward, has rendered odd lot indicators less reliable. Interpretation. When the odd lot balance index is high, odd lotters are selling more than they are buying and are therefore bearish on the market. To trade contrarily to the odd lotters, you should buy when they are selling, as indicated by a high OLBI, and sell when the odd lotters are bullish and buying, as indicated by a low OLBI. You can smooth day-to-day fluctuations of the odd lot balance index by plotting a 10-day moving average of the index. Example. The following chart shows the S&P 500 and a 10-day moving average of the odd lot balance index. Technical Analysis from A to Z. By Stephen B. Achelis. I drew a vertical line when the odd lotters were excessively pessimistic, which turned out to be a good time to buy. Calculation. Odd lot purchases/sales. Overview. Both of these indicators, odd lot purchases and odd lot sales, display what their names imply: the number of shares, in thousands, purchased or sold in odd lots. An odd lot is a stock transaction of less than 100 shares. Unfortunately, the trading of 99 share lots in an effort to skirt the uptick rule, which requires that specialists take short positions only when prices move upward, has rendered odd lot indicators less reliable. Interpretation. The odd lot trade numbers are used in several different ratios and indicators. By themselves, they show the investment activities of the odd lot traders. Being a contrarian indicator, a high number of odd lot purchases is generally considered bearish, whereas a high number of odd lot sales is considered bullish. The idea is to act opposite of the small, uninformed odd lot traders. However, it has been my experience that, for whatever reason, the odd lotters have tended to be on the right side of the market recently. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows the value line composite index and a 10-day moving average of odd lot sales. I drew vertical lines when the odd lotters were selling, as identified by relatively high moving average values. Conventional odd lot interpretation would have you buy at these points. However, in retrospect, it appears that these were appropriate short-term selling points. Odd lot short ratio. Overview. The odd lot short ratio, OLSR, is a market sentiment indicator that displays the daily ratio of odd lot short sales compared to odd lot buy/sell transactions. Investors short a stock in anticipation of the stock's price falling. Instead of the traditional transaction of buying at a lower price and profiting by selling at a higher price. The short sale transaction is just the opposite. To profit from a short sale, the stock must be sold at a higher price and bought, covered, at a lower price. An odd lot short is a short sale transaction involving less than 100 shares. Interpretation. If we could find an investor who was always wrong and do the exact opposite of him, we would always be right. Odd lot indicators strive to do just that. If we assume that small. Technical Analysis from A to Z. By Stephen B. Achelis. Investors, odd lotters, are inexperienced, and thus usually wrong, then trading. Contrarily to the odd lot traders should be profitable. The higher the OLSR indicator, the higher the percentage of odd lot shorts and the more likely the market will rise, proving the odd lotters wrong. Similarly, the lower the OLSR, the more likely a market decline. Generally this rule, invest contrarily to the odd lotters, has held true. Odd lotters tend to be reactive rather than proactive. High odd lot short ratios tend to come after major market declines, when investors should be buying, not selling, and low readings usually come after long market advances. In 1986, the number of odd lot shorts reached levels that were unheard of. The explanation I have heard for this is that specialists are placing multiple odd lot short orders to avoid the uptick rule, which states that a short order must be processed on an uptick. They do this on days with major declines in prices. If this explanation is true, it drastically complicates the interpretation of all odd lot indicators. It would mean that the odd lot indicators show what the littlest guy is doing, except when it reaches extreme readings, in which case it would show what the biggest guy, the members, is doing. Example. Refer to the examples inside the explanation of the odd lot balance index and odd lot purchases/sales. Calculation. The odd lot short ratio is calculated by dividing the number of odd lot short sales by the average number of odd lot transactions for the day. Because odd lots do not necessarily have a buyer and a seller for every transaction, we calculate the average number of transactions by adding the number of odd lot buy orders with the number of odd lot sell orders and then dividing by 2. On balance volume. Overview. On balance volume, OBV, is a momentum indicator that relates volume to price change. Technical Analysis from A to Z. By Stephen B. Achelis. On balance volume was developed by Joe Granville and originally presented in his book, New Strategy of Daily Stock Market Timing for Maximum Profits. Interpretation. On balance volume is a running total of volume. It shows if volume is flowing into or out of a security. When the security closes higher than the previous close, all of the days volume is considered up volume. When the security closes lower than the previous close, all of the day's volume is considered down volume. A full explanation of OBV is beyond the scope of this book. If you would like further information on OBV analysis, I recommend that you read Granville's book, New Strategy of Daily Stock Market Timing for Maximum Profits. The basic assumption regarding OBV analysis is that OBV changes precede price changes. The theory is that smart money can be seen flowing into the security by a rising OBV. When the public then moves into the security, both the security and the OBV will surge ahead. If the security's price movement precedes OBV movement, a non-confirmation has occurred. Non-confirmations can occur at bull market tops, when the security rises without, or before, the OBV, or at bear market bottoms, when the security falls without, or before, the OBV. The OBV is in a rising trend when each new peak is higher than the previous peak and each new trough is higher than the previous trough. Likewise, the OBV is in a falling trend when each successive peak is lower than the previous peak and each successive trough is lower than the previous trough. When the OBV is moving sideways and is not making successive highs and lows, it is in a doubtful trend. See Figure 47. Figure 47. Once a trend is established, it remains in force until it is broken. There are two ways in which the OBV trend can be broken. The first occurs when the trend changes from a rising trend to a falling trend, or from a falling trend to a rising trend. Technical Analysis from A to Z. By Stephen B. Achelis. The second way the OBV trend can be broken is if the trend changes to a doubtful trend and remains doubtful for more than 3 days. Thus, if the security changes from a rising trend to a doubtful trend and remains doubtful for only 2 days before changing back to a rising trend, the OBV is considered to have always been in a rising trend. When the OBV changes to a rising or falling trend, a breakout has occurred. Since OBV breakouts normally precede price breakouts, investors should buy long on OBV upside breakouts. Likewise, investors should sell short when the OBV makes a downside breakout. Positions should be held until the trend changes, as explained in the preceding paragraph. This method of analyzing on-balance volume is designed for trading short-term cycles. According to Granville, investors must act quickly and decisively if they wish to profit from short-term OBV analysis. Example: the following chart shows Pepsi and the on-balance volume indicator. I have labeled the OBV up, down, and doubtful trends. A falling trend, as you will recall, is defined by lower peaks and lower troughs. Conversely, a rising trend is defined by higher peaks and higher troughs. Calculation: on-balance volume is calculated by adding the day's volume to a cumulative total when the security's price closes up, and subtracting the day's volume when the security's price closes down. Technical Analysis from A to Z. By Stephen B. Achelis. If today's close is greater than yesterday's close, then. If today's close is less than yesterday's close, then. If today's close is equal to yesterday's close, then. Open interest. Overview. Open interest is the number of open contracts of a given future or option contract. An open contract can be a long or short contract that has not been exercised, closed out, or allowed to expire. Open interest is really more of a data field than an indicator. A fact that is sometimes overlooked is that a futures contract always involves a buyer and a seller. This means that one unit of open interest always represents two people, a buyer and a seller. Open interest increases when a buyer and seller create a new contract. This happens when the buyer initiates a long position and the seller initiates a short position. Open interest decreases when the buyer and seller liquidate existing contracts. This happens when the Buyer is selling an existing long position and the seller is covering an existing short position. Interpretation. By itself, open interest only shows the liquidity of a specific contract or market. However, combining volume analysis with open interest sometimes provides subtle clues to the flow of money in and out of the market. Rising volume and rising open interest confirm the direction of the current trend. Falling volume and falling open interest signal that an end to the current trend may be imminent. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows copper, open interest, the solid line, and volume, the dotted line. The open interest is for all copper contracts, not just the current contract. I drew a trend line, A, when both open interest and volume were increasing. This confirmed the upward trend of prices as shown by the trend line, B. I then drew a vertical line, C, when open interest and volume began to diverge. From this point, volume continued to increase while open interest decreased sharply. This warned of an end to the rising trend. Open 10 Trin. Overview. The Open 10 Trin is a smoothed variation of the ARMS index. It is a market breadth indicator that uses advancing/declining volume and advancing/declining issues to measure the strength of the market. Interpretation. The interpretation of Open 10 Trin, also called the Open Trading Index, is similar to the interpretation of the normal Trin. Readings above 0.90 are generally considered bearish and readings below 0.90 are considered bullish. Technical analysis from A to Z. By Stephen B. Achelis. The following table was reprinted from Peter Iliad's Stock Market Cycles. It shows what the DJIA did after the 10-day trend rose above the level of 1. Impressive. Table 9. First reading 1.0. Days to final low next market move. May 23, 1984. 3. 60-point rally. June 15, 1984. 1. 63-point rally. July 20, 1984. 3. 165-point rally. October 10, 1984. 0. 88-point rally. November 16, 1984. 1. 45-point rally. December 5, 1984. 3. 69-point rally. January 3, 1985. 1. 130-point rally. March 15, 1985. 1. 48-point rally. April 30, 1985. 2. 96-point rally. June 19, 1985. 3. 78-point rally. I created a similar table for the period 1985 through 1988. The table appears below. Table 10. First reading 1.0. Days to final low next market move. June 19, 1985. 0. 60-point rally. January 8, 1986. 2. 302-point rally. April 30, 1986. N/A. 16-point rally. July 15, 1986. 0. 41-point rally. September 11, 1986. 1. 141-point rally. January 2, 1987. 0. 445-point rally. October 15, 1987. 2. 289-point rally. November 13, 1987. 4. 68-point rally. November 27, 1987. 5. 285-point rally. Technical analysis from A to Z. By Stephen B. Achelis. January 14, 1988. 5. 285-point rally. February 8, 1988. 5. 79-point rally. March 11, 1988. 0. 53-point rally. April 4, 1988. 0. 127-point rally. May 12, 1988. 0. 39-point rally. May 17, 1988. 4. 211-point rally. July 1, 1988. N/A. 78-point rally. August 12, 1988. 7. 111-point rally. November 16, 1988. 0. 309-point rally. October 30, 1989. 5. 171-point rally. December 18, 1989. 2. 109-point rally. Calculation. The open 10 trend is calculated by keeping a 10-day total of each of the trends. Components before performing the trend calculation. Option analysis. Overview. The most widely used option pricing model is the Black-Scholes option valuation model, which was developed by Fisher Black and Myron Scholes in 1973. The Black-Scholes model helps determine the fair market value of an option based on the security's price and volatility, time until expiration, and the current market interest rate. The following assumptions were made by Black and Scholes when the model was developed. 1. Markets are frictionless. In other words, there are no transaction costs or taxes. All market participants may borrow and lend at the riskless rate of interest. There are no penalties for short selling, and all securities are infinitely divisible, i.e., technical analysis from A to Z. By Stephen B. Achelis. Fractional shares can be purchased. 2. Stock prices are log-normally distributed, i.e., they follow a bell curve. This means that a stock can double in price as easily as it can drop to half its price. 3. Stocks do not pay dividends or make any distributions. The model is often modified to allow for dividend adjustments. 4. The option can only be exercised on the expiration date. The components of the option model are security price, volatility, option life, market interest rate, and dividend, if any. I suggest you refer to the book Option Volatility and Pricing Strategies, by Sheldon Natenberg for more information on calculations and strategies using the Black-Scholes model. Interpretation. Put/call price. The put/call price is the main output of the Black-Scholes model. It shows how much an option should sell for based on the various components that make up the model, example, volatility, option life, security price, etc. It helps answer the question, is the option overpriced or underpriced? The usefulness of the put/call price is basically twofold. 1. It helps you locate mispriced options. The option purchaser can use the model to find options that are underpriced. The option writer can use the model to find options that are overpriced. 2. It helps you form a riskless hedge to earn arbitrage profits. For example, you could buy undervalued calls and then short the underlying stock. This creates a riskless hedge because regardless of whether the security's price goes up or down, the two positions will exactly offset each other. You would then wait for the option to return to its fair market value to earn arbitrage profits. Delta, below, is used to determine the number of shares to purchase in order to form a riskless hedge. Delta shows the amount that the option's price will change if the underlying securities price changes by $1. Technical analysis from A to Z. By Stephen B. Achelis. For example, If XYZ is selling for $25.00/share, a call option on XYZ is selling for $2. And the delta is 75%, then the option's price should increase 75 cents, to $2.75, if the price of XYZ increases to $26.00/share. In other words, the option should go up 75 cents for each $1 that XYZ goes up. If an option is deep in the money, then it will have a high delta, because almost all of the gain/loss in the security will be reflected in the option price. Conversely, deep out of the money options will have a low delta, because very little of the gain/loss in the security is reflected in the option price. If you don't have a computer, the rough rule of thumb for calculating delta is 75% for an option $5 in the money, 50% for an option at the money, and %25 for an option $5 out of the money. As an in-the-money option nears expiration, the delta will approach 100% because the amount of time remaining for the option to move out of the money is small. Delta is also used to determine the correct number of shares to buy/short to form a riskless hedge. For example, suppose the delta on a put option is 66%. A riskless hedge would result from owning a ratio of 2/3, 66%, a position in stock, i.e., 66 shares, to every one long position in a put option contract. If the stock price goes up 1 point, then the stock position will increase $66. This $66 increase should be exactly offset by a $66 decrease in the value of the put option contract. As discussed on earlier, forming a riskless hedge gives the investor the potential of earning arbitrage profits, by profiting from the undervalued option's return to its fair market value, i.e., the price at which the option is neither overpriced nor underpriced. Theoretically, the market will eventually value underpriced options at their fair market value. However, it should be noted that high transaction costs may undermine this theory. Gamma shows the anticipated change in delta, given a 1-point increase in the underlying security. Thus, it shows how responsive delta is to a change in the underlying security's price. For example, a gamma of 4 indicates that the delta will increase 4 points, example from 50% to 54%, for each 1-point increase in the underlying security's price. Gamma indicates the amount of risk involved with an option position. A large gamma indicates higher risk, because the value of the option can change more quickly. However, a trader may desire higher risk depending on the strategy employed. Option life. Option life shows the number of days until expiration. Generally speaking, the longer the time until expiration, the more valuable the option. Technical analysis from A to Z. By Stephen B. Achelis. A graph of option life appears as a stepped line from the upper left to the lower right side of the screen. The reason the line is stepped is because of weekends and holidays. For example, on Friday there may be 146 days to expiration, and on the following Monday only 143 days remaining. Theta shows the change in the option's price, in points, due to the effect of time alone. The longer the time until expiration, the less effect that time has on the price of the option. However, as the option nears expiration, the effect can be great, particularly on out-of-the-money options. Theta is also referred to as time decay. For example, a theta value of -0.0025 means that the option lost 1/4 of 1 cent due to the passage of time alone. The effect of time on the option price is almost always positive. The more time until expiration, the better chance the option has of being in the money at expiration. The only Exception to this positive relationship is deep in the money put options with an expiration date far into the future. All other things being equal, options with low thetas are more preferable for purchase than are those with high thetas. Vega. Vega shows the change in the option price due to an assumed 1% increase in the underlying security's volatility. Vega shows the dollar amount of gain that should be expected if the volatility goes up 1 point, all else being equal. The effect of volatility on the option price is always positive. The greater the volatility of the underlying security, the better chance the option has of being in the money at expiration. Therefore, options with higher volatilities will cost more than those with lower volatilities. Since Vega measures the sensitivity of an option to a change in volatility, options with higher Vegas are more preferable for purchase than those with low Vegas. Volatility. Volatility is a measurement that shows the degree of fluctuation that a security experiences over a given time frame. Wide price movements over a short time frame are characteristic of high volatility stocks. Volatility is the only input parameter of the Black-Scholes model, example security price. Volatility, option life, market interest rate, that is calculated, yet the accuracy of the model is highly dependent on a good volatility figure. The best measurement of volatility. Technical analysis from A to Z. By Stephen B. Achelis. Is the one that captures future price movements. But if we knew what future price movements would be, we would care less about the Black-Scholes model we'd be trading. However, reality forces us to estimate volatility. There are two ways to estimate volatility for use with the Black-Scholes model: historical volatility and implied volatility. Historical volatility measures the actual volatility of the securities prices using a standard deviation-based formula. It shows how volatile prices have been over the last X time periods. The advantage of historical volatility is that can be calculated using only historical security prices. When you calculate the Black-Scholes put/call price using historical volatility, most options appear overpriced. A more widely used measure of option volatility is called implied volatility. Implied volatility is the amount of volatility that the option market is assuming, i.e., implying for the option. To calculate implied volatility, the actual option price, security price, strike price, and the option expiration date are plugged into the Black-Scholes formula. The formula then solves for the implied volatility. Options of high volatility stocks are worth more, i.e., carry higher premiums, than those with low volatility, because of the greater chance the option has of moving in the money by expiration. Option purchasers normally prefer options with high volatilities and option writers normally prefer options with low volatilities, all else being equal. Calculation. For exact mathematical formulas used in calculating option values, I recommend Option Volatility and Pricing Strategies by Sheldon Natenberg. The formula for the Black-Scholes option pricing model is widely available in many books and publications. The original work by Black and Scholes was only done on equity call options. Since their work was originally published, extensions of their model have been developed, such as models for put options and options on futures. Gamma, theta, and Vega calculations are all extensions of the original Black-Scholes model. Adjusting the model for dividends provides a more accurate calculation of the options fair market value. A popular adjustment method assumes that dividend payments are paid out continuously. Overbought/oversold. Overview. The overbought/oversold, OB/OS, indicator is a market breadth indicator based on the smoothed difference between advancing and declining issues. Interpretation. Technical Analysis from A to Z. By Stephen B. Achelis. The OB/OS indicator shows when the stock market is overbought, and a correction is due, and when it is oversold, and a rally is due. Readings above plus 200 are generally considered bearish and readings below minus 200 are generally considered bullish. When the OB/OS indicator falls below plus 200, a sell signal is generated. Similarly, a buy signal is generated when the OB/OS indicator rises above 200. As with all OB/OS type indicators, extreme readings may be a sign of a change in investor expectations and may not be followed by the expected correction. Refer to the discussion on the advance/decline ratio and the McClellan oscillator for additional comments on extremely overbought/oversold conditions. Example: the following chart shows the DJIA and the overbought/oversold indicator. I drew buy and sell arrows when the indicator penetrated the plus 200/-200 levels. The OB/OS indicator works very well in this type of trading range market. Calculation: the overbought/oversold indicator is a 10-period exponential moving average of the difference between the number of advancing and declining issues. Technical Analysis from A to Z. By Stephen B. Achelis. Parabolic SAR. Overview. The parabolic time/price system, developed by Wells Wilder, is used to set trailing price stops and is usually referred to as the SAR, stop and reversal. This indicator is explained thoroughly in Wilder's book, New Concepts in Technical Trading Systems. Interpretation: the parabolic SAR provides excellent exit points. You should close long positions when the price falls below the SAR and close short positions when the price rises above the SAR. If you are long, i.e., the price is above the SAR will move up every day, regardless of the direction the price is moving. The amount the SAR moves up depends on the amount that prices move. Example: the following chart shows Compaq and its parabolic SAR. You should be long when the SAR is below prices and short when it is above prices. The parabolic SAR is plotted as shown in Wilder's book. Each SAR stop level point is displayed on the day in which it is in effect. Note that the SAR value is today's, not tomorrow's stop level. Technical Analysis from A to Z. By Stephen B. Achelis. Calculation. It is beyond the scope of this book to explain the calculation of the parabolic SAR. Refer to Wilder's book New Concepts in Technical Trading, for detailed calculation. Information. Patterns. Overview. A basic principle of technical analysis is that security prices move in trends. We also know that trends do not last forever. They eventually change direction, and when they do, they rarely do so on a dime. Instead, prices typically decelerate, pause, and then reverse. These phases occur as investors form new expectations and by doing so, shift the securities supply/demand lines. The changing of expectations often causes price patterns to emerge. Although no two markets are identical, their price patterns are often very similar. Predictable price behavior often follows these price patterns. Chart patterns can last from a few days to many months or even years. Generally speaking, the longer a pattern takes to form, the more dramatic the ensuing price move. Interpretation. The following sections explain some of the more common price patterns. For more information on chart patterns, I suggest the book, Technical Analysis of Stock Trends by Robert Edwards and John McGee. Head and Shoulders. The head and shoulders price pattern is the most reliable and well-known chart pattern. It gets its name from the resemblance of a head with two shoulders on either side. The reason this reversal pattern is so common is due to the manner in which trends typically reverse. A uptrend is formed as prices make higher highs and higher lows in a stair-step fashion. The trend is broken when this upward climb ends. As you can see in the following illustration, the left shoulder and the head are the last two higher highs. Technical analysis from A to Z. By Stephen B. Achelis. The right shoulder is created as the bulls try to push prices higher, but are unable to do so. This signifies the end of the uptrend. Confirmation of a new downtrend occurs when the neckline is penetrated. During a healthy uptrend, volume should increase during each rally. A sign that the trend is weakening occurs when the volume accompanying rallies is less than the volume accompanying the preceding rally. In a typical head and shoulders pattern, volume decreases on the head and is especially light on the right shoulder. Following the penetration of the neckline, it is very common for prices to return to the neckline in a last effort to continue the uptrend, as shown in the preceding chart. If prices are then unable to rise above the neckline, they usually decline rapidly on increased volume. An inverse, or upside down, head and shoulders pattern often coincides with market bottoms. As with a normal head and shoulders pattern, volume usually decreases as the pattern is formed and then increases as prices rise above the neckline. Rounding tops and bottoms. Rounding tops occur as expectations gradually shift from bullish to bearish. The gradual, yet steady shift forms a rounded top. Rounding bottoms occur as expectations gradually shift from bearish to bullish. Volume during both rounding tops and rounding bottoms often mirrors the bowl-like shape of prices during a rounding bottom. Volume, which was high during the previous trend, decreases as expectations shift and traders become indecisive. Volume then increases as the new trend is established. The following chart shows Goodyear and a classic rounding bottom formation. Technical analysis from A to Z. By Stephen B. Achelis. Triangles. A triangle occurs as the range between peaks and troughs narrows. Triangles typically occur as prices encounter a support or resistance level which constricts the prices. A symmetrical triangle occurs when prices are making both lower highs and higher lows. An ascending triangle occurs when there are higher lows, as with a symmetrical triangle, but the highs are occurring at the same price level due to resistance. The odds favor an upside breakout from an ascending triangle. A descending triangle occurs when there are lower highs, as with a symmetrical triangle, but the lows are occurring at the same price level due to support. The odds favor a downside breakout from a descending triangle. Just as pressure increases when water is forced through a narrow opening, the pressure of prices increases as the triangle pattern forms. Prices will usually break out rapidly from a triangle. Breakouts are confirmed when they are accompanied by an increase in volume. The most reliable breakouts occur somewhere between half and 3/4 of the distance between the beginning and end, apex, of the triangle. There are seldom many clues as to the direction prices will break out of a symmetrical triangle. If prices move all the way through the triangle to the apex, a breakout is unlikely. Technical analysis from A to Z. By Stephen B. Achelis. The following chart shows bowing and a descending triangle. Note the strong downside breakout on increased volume. Double tops and bottoms. A double top occurs when prices rise to a resistance level on significant volume, retreat, and subsequently return to the resistance level on decreased volume. Prices then decline, marking the beginning of a new downtrend. A double bottom has the same characteristics as a double top except it is upside down. The following chart shows caterpillar and a double bottom pattern. Technical analysis from A to Z. By Stephen B. Achelis. Percent retracement. Overview. A characteristic of a healthy bull market is that it makes higher highs and higher lows. This indicates a continual upward shift in expectations and the supply/demand lines. The amount that prices retreat following a higher high can be measured using a technique referred to as percent retracement. This measures the percentage that prices retraced from the high to the low. For example, if a stock moves from a low of 50 to a high of 100 and then retraces to 75. The move from 100 to 75, 25 points, retraced 50% of the original move from 50 to 100. Interpretation. Measuring the percent retracement can be helpful when determining the price levels at which prices will reverse and continue upward. During a vigorous bull market, prices often retrace up to 33% of the original move. It is not uncommon for prices to retrace up to 50%. Retracements of more than 66% almost always signify an end to the bull market. Some investors feel that the similarities between 33%, 50%, and 66% and the Fibonacci numbers of 38.2%, 50%, and 61.8% are significant. These investors will use Fibonacci levels to view retracement levels. Example. I labeled the following chart of Great Western at 3 points, labeled A, B, and C. These points define the price before the price move, A, at the end of the price move, B, and at the retraced price, C. In this example, prices have retraced 61.5% of the original price move. Technical Analysis from A to Z. By Stephen B. Achelis. Performance Overview. The performance indicator displays a security's price performance as a percentage. This is sometimes called a normalized chart. Interpretation. The performance indicator displays the percentage that the security has increased since the first period displayed. For example, if the performance indicator is 10, it means that the security's price has increased 10% since the first period displayed on the left side of the chart. Similarly, a value of -10% means that the security's price has fallen by 10% since the first period displayed. Performance charts are helpful for comparing the price movements of different securities. Example. The following chart shows United Airlines and its performance indicator. The indicator shows that United's price has increased 16% since the beginning of 1993. Calculation. The performance indicator is calculated by dividing the change in prices by the first price displayed. Technical Analysis from A to Z. By Stephen B. Achelis. Point and Figure. Overview. Point and figure, P and F, charts differ from traditional price charts in that they completely disregard the passage of time and only display changes in prices. Rather than having price on the y-axis and time on the x-axis, P and F charts display price changes on both axes. This is similar to Kajai, Renko, and three-line break charts. Interpretation. Point and figure charts display the underlying supply and demand of prices. A column of XS shows that demand is exceeding supply, a rally, a column of OS shows that supply is exceeding demand, a decline, and a series of short columns shows that supply and demand are relatively equal. There are several chart patterns that regularly appear in P and F charts. These include double tops and bottoms, bullish and bearish signal formations, bullish and bearish, symmetrical triangles, triple tops and bottoms, etc. It is beyond the scope of this book to fully explain all of these patterns. Example. The following two charts both show the prices of Atlantic Richfield. The first chart displays prices in P and F, the second chart displays prices as high, low, close bars. As I mentioned above, P and F charts focus only on price action. Looking at this P and F chart, You can see that prices were initially contained between a support level at 114 and a resistance level at 121. When prices broke above the resistance level at 121, the long column of XS, that level became the new support level. This new support level eventually failed. The long column of OS, prices retested the support at 114, made a small rally, and then fell below the 114 support level. Technical Analysis from A to Z. By Stephen B. Achelis. This next chart shows the same pricing information as the preceding PNF chart. You can see that the support and resistance levels are also identifiable in this bar chart, but the PNF chart made it much easier to identify them. Calculation. Point and figure charts display an X when prices rise by the box size, a value you specify, and display an O when prices fall by the box size. Note that no XS or OS are drawn if prices rise or fall by an amount that is less than the box size. Each column can contain either XS or OS, but never both. In order to change columns, example from an X column to an O column, prices must reverse by the reversal amount. Another value you specify, multiplied by the box size. For example, if the box size is 3 points and the reversal amount is 2 boxes, then prices must reverse direction 6 points, 3 multiplied by 2, in order to change columns. If you are in a column of XS. Technical Analysis from A to Z. By Stephen B. Achelis. The price must fall 6 points to change to a column of OS. If you are in a column of OS, the price must rise 6 points to change to a column of XS. The changing of columns identifies a change in the trend of prices. When a new column of XS appears, it shows that prices are rallying higher. When a new column of OS appears, it shows that prices are moving lower. Because prices must reverse direction by the reversal amount, the minimum number of XS or OS that can appear in a column is equal to the reversal amount. The common practice is to use the high and low prices, not just the close, to decide if prices have changed enough to display a new box. Positive Volume Index. Overview. The Positive Volume Index, PVI, focuses on days where the volume increased from the previous day. The premise being that the crowd takes positions on days when volume increases. Interpretation. Interpretation of the PVI assumes that on days when volume increases, the crowd following uninformed investors are in the market. Conversely, on days with decreased volume, the smart money is quietly taking positions. Thus, the PVI displays what the not so smart money is doing. The Negative Volume Index displays what the smart money is doing. Note, however, that the PVI is not a contrarian indicator. Even though the PVI is supposed to show what the not so smart money is doing, it still trends in the same direction as prices. Technical Analysis from A to Z. By Stephen B. Achelis. The following table summarizes NVI and PVI data from 1941 through 1975 as explained in Stock Market Logic, by Norman Fosbach. Table 11. Indicator. Indicator. Relative to 1 year. Moving average. Probability that bull market is in progress. Probability that bear market is in progress. NVI above 96%, 4%. PVI above 79%, 21%. NVI below 47%, 53%. PVI below 33%, 67%. As you can see, NVI is excellent at identifying bull markets, i.e., when the NVI is above its 1-year moving average, and the PVI is pretty good at identifying bull markets. When the PVI is above its moving average, and bear markets, i.e., when the PVI is below its moving average. Example. The following chart shows the NVI, the PVI, and the Dow Jones Industrial Average (DJIA) over a 4-year period, weekly data. I labeled both the NVI and PVI indicators bullish or bearish depending on if they were above or below their 52-week moving averages. Technical Analysis from A to Z. By Stephen B. Achelis. I then labeled the DJIA as bullish when either the NVI or PVI was above its moving average, and as very bullish when both the indicators were above their moving averages. Calculation. If today's volume is greater than yesterday's volume, then if today's volume is less than or equal to yesterday's volume, then because rising prices are usually associated with rising volume, the PVI usually trends upward. Price and volume trend. Overview. The price and volume trend, PVT, is similar to on-balance volume, OBV, in that it is a cumulative total of volume that is adjusted depending on changes in closing prices. But where OBV adds all volume on days when prices close higher and subtracts all volume on days when prices close lower, the PVT adds/subtracts only a portion of the daily volume. The amount of volume added to the PVT is determined by the amount that prices rose or fell relative to the previous day's close. Interpretation. The interpretation of the price and volume trend is similar to the interpretation of on-balance volume and the volume accumulation/distribution line. Many investors feel that the PVT more accurately illustrates the flow of money into and out of a security than does OBV. This is because OBV adds the same amount of volume to the indicator regardless of whether the security closes up a fraction of a point or doubles in price. Whereas, the PVT adds only a small portion of volume to the indicator. When the price changes by a small percentage and adds a large portion of volume to the indicator when the price changes by a large percentage. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows DuPont and the PVT. The bullish divergence, the PVT was trending higher while prices trend lower, was followed by a strong price increase. Calculation. The PVT is calculated by multiplying the day's volume by the percent that the securities price changed, and adding this value to a cumulative total. For example, if the securities price increased 0.5% on volume of 10,000 shares, we would add 50, i.e., 0.005 * 10,000, to the PVT. If the securities price had closed down 0.5%, we would have subtracted 50 from the PVT. Price oscillator. Overview. The price oscillator displays the difference between two moving averages of a security's price. The difference between the moving averages can be expressed in either points or percentages. The price oscillator is almost identical to the MACD, except that the price oscillator can use any two user-specified moving averages. The MACD always uses 12 and 26-day moving averages, and always expresses the difference in points. Technical Analysis from A to Z. By Stephen B. Achelis. Interpretation. Moving average analysis typically generates buy signals when a short-term moving average, or the securities price, rises above a longer-term moving average. Conversely, sell signals are generated when a shorter-term moving average, or the securities price, falls below a longer-term moving average. The price oscillator illustrates the cyclical and often profitable signals generated by these one or two moving average systems. Example. The following chart shows Kellogg and a 10-day/30-day price oscillator. In this example, the price oscillator shows the difference between the moving averages as percentages. I drew buy arrows when the price oscillator rose above 0 and sell arrows when the indicator fell below 0. This example is typical of the price oscillator's effectiveness. Because the price oscillator is a trend-following indicator, it does an outstanding job of keeping you on the right side of the market during trending periods, as shown by the arrows labeled B, E, and F. However, during less decisive periods, the price oscillator produces small losses, as shown by the arrows labeled A, C, and D. Calculation. When the price oscillator displays the difference between the moving averages in points, it subtracts the longer-term moving average from the short-term average. Technical analysis from A to Z. By Stephen B. Achelis. When the price oscillator displays the difference between the moving averages in percentages, it divides the difference between the averages by the shorter-term moving average. Price rate of change. Overview. The price rate of change, ROC, indicator displays the difference between the current price and the price X time periods ago. The difference can be displayed in either points or as a percentage. The momentum indicator displays the same information, but expresses it as a ratio. Interpretation. It is a well-recognized phenomenon that security prices surge ahead and retract in a cyclical wave-like motion. This cyclical action is the result of the changing expectations as bulls and bears struggle to control prices. The ROC displays the wave-like motion in an oscillator format by measuring the amount that prices have changed over a given time period. As prices increase, the ROC rises. As prices fall, the ROC falls. The greater the change in prices, the greater the change in the ROC. The time period used to calculate the ROC may range from 1 day, which results in a volatile chart showing the daily price change, to 200 days, or longer. The most popular time periods are the 12 and 25-day ROC for short to intermediate term trading. These time periods were popularized by Gerald Appel and Fred Hitchler in their book, Stock Market Trading Systems. The 12-day ROC is an excellent short to intermediate term overbought/oversold indicator. The higher the ROC, the more overbought the security; the lower the ROC, the more likely a rally. However, as with all overbought/oversold indicators, it is prudent to wait for the market to begin to correct, i.e., turn up or down, before placing your trade. A market that appears overbought may remain overbought for some time. In fact, extremely overbought/oversold readings usually imply a continuation of the current trend. The 12-day ROC tends to be very cyclical, oscillating back and forth in a fairly regular cycle. Often, price changes can be anticipated by studying the previous cycles of the ROC and relating the previous cycles to the current market. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows the 12-day ROC of Walgreen expressed in percent. I drew buy arrows each time the ROC fell below, and then rose above, the oversold level of -6.5. I drew sell arrows each time the ROC rose above, and then fell below, the overbought level of +6.5. The optimum overbought/oversold levels, example 6.5, vary depending on the security being analyzed and overall market conditions. I selected 6.5 by drawing a horizontal line on the chart that isolated previous extreme levels of Walgreen's 12-day ROC. Calculation. When the rate of change displays the price change in points, it subtracts the price X time periods ago from today's price. When the rate of change displays the price change as a percentage, it divides the price Change by price X time periods ago. Technical analysis from A to Z. By Stephen B. Achelis. Public short ratio. Overview. The public short ratio, PSR, shows the relationship between the number of public short sales and the total number of short sales. The public short ratio is sometimes referred to as the non-member short ratio. Interpretation. The interpretation of the PSR assumes one premise, that of the short sellers, the public is the worst, well, except for the odd lot traders whose indicators begin with the odd lot balance index. If this is true, then we should buy when the public is shorting and sell when the public is long. Historically, this premise has held true. Generally speaking, the higher the PSR, the more bearish the public, and the more likely prices will increase, given the above premise. Historically, it has been considered bullish when the 10-week moving average of the PSR is above 25% and bearish when the moving average is below 25%. The further the moving average is in the bullish or bearish territory, the more likely it is that a correction/rally will take place. Also, the longer the indicator is in the bullish/bearish territory, the better the chances of a market move. For more information on the PSR, I suggest reading the discussion on the non-member short ratio in Stock Market Logic, by Norman G. Fosbach. Example. The following chart shows the New York Stock Exchange Index and a 10-week moving average of the public short ratio. Technical analysis from A to Z. By Stephen B. Achelis. The PSR dropped below 25% into bearish territory at the point labeled A. Over the next several months, the PSR continued to move lower as the public became more and more bullish. During this period, prices surged upward, adding to the bullish frenzy. The subsequent crash of 1987 gave the public a strong dose of reality. Since the crash of 1987, the PSR has remained high, telling us that the public doesn't expect higher prices, a bullish sign. Calculation. The public short ratio is calculated by dividing the number of public short sales by the total number of short sales. The result is the percentage of public shorts. Put/calls ratio. Overview. Developed by Martin Zweig, the put/calls ratio, P/C ratio, is a market sentiment indicator that shows the relationship between the number of puts to calls traded on the Chicago Board Options Exchange, CBOE. Traditionally, options are traded by unsophisticated, impatient investors who are lured by the potential for huge profits with a small capital outlay. Interestingly, the actions of these investors provide excellent signals for market tops and bottoms. Interpretation. A call gives an investor the right to purchase 100 shares of stock at a predetermined price. Investors who purchase calls expect stock prices to rise in the coming months. Conversely, a put gives an investor the right to sell 100 shares of stock at a preset price. Investors purchasing puts expect stock prices to decline. An exception to these general rules is that puts and calls can also be purchased to hedge other investments, even other options. Because investors who purchase calls expect the market to rise and investors who purchase puts expect the market to decline, the relationship between the number of puts to calls illustrates the bullish/bearish expectations of these traditionally ineffective investors. The higher the level of the P/C ratio, the more bearish these investors are on the market. Conversely, lower readings indicate high call volume and thus bullish expectations. Technical analysis from A to Z. By Stephen B. Achelis. The P/C ratio is a contrarian indicator. When it reaches excessive levels, the market usually corrects by moving the opposite direction. The following table, general guidelines. for interpreting the P/C ratio. However, the market does not have to correct itself just because investors are excessive in their bullish/bearish beliefs. As with all technical analysis tools, you should use the P/C ratio in conjunction with other market indicators. Table 12. P/C ratio 10 P/C ratio 4-day. Moving week moving. Average. Average. Excessively bearish, buy. Greater than 80. Greater than 70. Excessively bullish, sell. Less than 45. Less than 40. Example. The following chart shows the S&P 500 and a 4-week moving average of the put/calls ratio. I drew buy arrows when investors were excessively pessimistic, greater than 70, and sell arrows when they were excessively optimistic, less than 40. The arrows certainly show that investors are buying puts when they should be buying calls, and vice versa. Technical Analysis from A to Z. By Stephen B. Achelis. Calculation. The put/calls ratio is calculated by dividing the volume of puts by the volume of calls. Quadrant lines. Overview. Quadrant lines are a series of horizontal lines that divide the highest and lowest values, usually prices, into 4 equal sections. Interpretation. Quadrant lines are primarily intended to aid in the visual inspection of price movements. They help you see the highest, lowest, and average price during a specified period. Example. An interesting technique is to display a linear regression trend line and quadrant lines. This combination displays the highest, lowest, and average price, as well as the average slope of the prices. I used this technique on the following chart of Black & Decker. Calculation. Quadrant lines are calculated by finding the highest high and the lowest low during the time period being analyzed. The top line is drawn at the highest price during the time period and the bottom line is drawn at the lowest price during the time period. The Technical Analysis from A to Z. By Stephen B. Achelis. Remaining 3 lines are then drawn so they divide the section between the highest high and the lowest low into 4 equal sections. The center line, the mean, is usually displayed as a dotted line. Relative strength, comparative. Overview. Comparative relative strength compares 2 securities to show how the securities are performing relative to each other. Be careful not to confuse comparative relative strength with the relative strength index. Interpretation. Comparative relative strength compares a security's price change with that of a base security. When the comparative relative strength indicator is moving up, it shows that the security is performing better than the base security. When the indicator is moving sideways, it shows that both securities are performing the same, i.e., rising and falling by the same percentages. When the indicator is moving down, it shows that the security is performing worse than the base security, i.e., not rising as fast or falling faster. Comparative relative strength is often used to compare a security's performance with a market index. It is also useful in developing spreads, i.e., buy the best performer and short the weaker issue. Example. In the following charts, the top chart displays both Microsoft and IBM's prices. Technical Analysis from A to Z. By Stephen B. Achelis. The bottom chart shows the comparative relative strength of IBM compared to Microsoft. The comparative relative strength indicator shows that IBM's price outperformed Microsoft's price during the last 3 months of 1993. It also shows that IBM's price then underperformed Microsoft's price during the first 3 months of 1994. I drew the trend lines on the comparative relative strength indicator using the linear regression technique. Calculation. The comparative relative strength indicator is calculated by dividing one security's price by a second security's price, the base security. The result of this division is the ratio, or relationship, between the two securities. Relative Strength Index. Overview. The Relative Strength Index, RSI, is a popular oscillator. It was first introduced by Wells Wilder in an article in Commodities, now known as Futures, magazine in June 1978. Step-by-step instructions on calculating and interpreting the RSI are also provided. In Mr. Wilder's book, New Concepts in Technical Trading Systems. The name Relative Strength Index is slightly misleading as the RSI does not compare the relative strength of two securities, but rather the internal strength of a single security. A more appropriate name might be Internal Strength Index. Relative strength charts that compare two market indices, which are often referred to as comparative relative strength. Interpretation. When Wilder introduced the RSI, he recommended using a 14-day RSI. Since then, the 9-day and 25-day RSIs have also gained popularity. Because you can vary the number of time periods in the RSI calculation, I suggest that you experiment to find the period that works best for you. The fewer days used to calculate the RSI, the more volatile the indicator. The RSI is a price-following oscillator that ranges between 0 and 100. A popular method of analyzing the RSI is to look for a divergence in which the security is making a new high, but the RSI is failing to surpass its previous high. This divergence is an indication of an impending reversal. When the RSI then turns down and falls below its most recent trough, it is said to have completed a failure swing. The failure swing is considered a confirmation of the impending reversal. Technical Analysis from A to Z. By Stephen B. Achelis. In Mr. Wilder's book, he discusses 5 uses of the RSI in analyzing commodity charts. These methods can be applied to other security types as well. Tops and bottoms. The RSI usually tops above 70 and bottoms below 30. It usually forms these tops and bottoms before the underlying price chart. Chart formations. The RSI often forms chart patterns such as head and shoulders, page 215, or triangles, page 216, that may or may not be visible on the price chart. Failure swings. Also known as support or resistance penetrations or breakouts. This is where the RSI surpasses a previous high, peak, or falls below a recent low, trough. Support and resistance. The RSI shows, sometimes more clearly than price themselves, levels of support and resistance. Divergences. As discussed above, divergences occur when the price makes a new high, or low, that is not confirmed by a new high, or low, in the RSI. Prices usually correct and move in the direction of the RSI. For additional information on the RSI, refer to Mr. Wilder's book. Example. The following chart shows PepsiCo and its 14-day RSI. Technical Analysis from A to Z. By Stephen B. Achelis. A bullish divergence occurred during May and June as prices were falling while the RSI was rising. Prices subsequently corrected and trended upward. Calculation. The RSI is a fairly simple formula, but is difficult to explain without pages of examples. Refer to Wilder's book for additional calculation information. The basic formula is where Renko. Overview. The Renko charting method is thought to have acquired its name from Renga, which is the Japanese word for bricks. Renko charts are similar to 3-line break charts except that in a Renko chart, a line, or brick as they're called, is drawn in the direction of the prior move only if prices move by a minimum amount, i.e., the box size. The bricks are Always equal in size. For example, in a 5-unit Renko chart, a 20-point rally is displayed. As for 5-unit tall Renko bricks, Kajai charts were first brought to the United States by Stephen Nissen when he published the book, Beyond Candlesticks. Interpretation. Basic trend reversals are signaled with the emergence of a new white or black brick. A new white brick indicates the beginning of a new uptrend. A new black brick indicates the beginning of a new downtrend. Since the Renko chart is a trend-following technique, there are times when Renko charts produce whipsaws, giving signals near the end of short-lived trends. However, the expectation with a trend-following technique is that it allows you to ride the major portion of significant trends. Since a Renko chart isolates the underlying price trend by filtering out the minor price changes, Renko charts can also be very helpful when determining support and resistance levels. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following charts show Intel as a classic high-low close bar chart and as a 2.5-unit Renko chart. I drew buy and sell arrows on both charts when trend reversals occurred in the Renko chart. You can see that although the signals were late, they did ensure that you invested. With the major trend calculation, Renko charts are always based on closing prices. You specify a box size which determines the minimum price change to display. To draw Renko bricks, today's close is compared with the high and low of the previous brick, white or black. If the closing price rises above the top of the previous brick by at least the box size, one or more white bricks are drawn in new columns. The height of the bricks is always equal to the box size. If the closing price falls below the bottom of the previous brick by at least the box size, one or more black bricks are drawn in new columns. Again, the height of the bricks is always equal to the box size. If prices move more than the box size, but not enough to create two bricks, only one brick is drawn. For example, in a 2-unit Renko chart, if the prices move from 100 to 103, only one white brick is drawn from 100 to 102. The rest of the move, from 102 to 103, is not shown on the Renko chart. Technical Analysis from A to Z. By Stephen B. Achelis. Speed Resistance Lines. Overview. Speed resistance lines, SRL, sometimes called 1/3-2/3 lines, are a series of trend lines that divide a price move into 3 equal sections. They are similar in construction and interpretation to Fibonacci fan lines. Interpretation. Speed resistance lines display 3 trend lines. The slope of each line defines a different rate at which pricing expectations are changing. Prices should find support above the 2/3 line. When prices do fall below the 2/3 line, they should quickly drop to the 1/3 line where they should then again find support. Example. The following charts show McDonald's price and speed resistance lines. Technical Analysis from A to Z. By Stephen B. Achelis. The initial trend line was drawn from the low point labeled A to the high point labeled B. You can see that prices found support each time they fell to the 2/3 line. When prices finally penetrated the 2/3 line, at point C, they quickly fell to the 1/3 line where they again found support. Calculation. To draw speed resistance lines. 1. Draw a line from a major low to a major high. 2. Draw a vertical line on the day the major high occurred. Divide this vertical line into thirds. 3. Draw lines from the major low so they intersect the vertical line at the 1/3 and 2/3 levels. Spreads. Overview. Spreads show the difference in price between two securities. Spreads are normally calculated using options. Interpretation. A spread involves buying one security and selling another with the goal of profiting from the narrowing or expanding of the difference between the two securities. For example, you might buy gold and short silver with the expectation that the price of gold will rise faster, or fall more slowly, than the price of silver. Technical Analysis from A to Z. By Stephen B. Achelis. You can also spread a single security by buying one contract and selling another. For example, buy an October contract and sell a December contract. Example. The following charts show live hogs, top chart, pork bellies, middle chart, and the spread between the hogs and bellies, bottom chart. This spread involves buying the hogs and shorting the bellies with the anticipation that hogs will rise faster, or fall more slowly, than bellies. You can see that during the time period shown, both hogs and bellies decreased in price. As desired, the price of hogs fell less than the price of bellies. This is shown by the spread narrowing from -10.55 to -3.58, with a resulting profit of 6.97. Standard deviation. Overview. Standard deviation is a statistical measure of volatility. Standard deviation is typically used as a component of other indicators, rather than as a standalone indicator. For example, Bollinger Bands are calculated by adding a security's standard deviation to a moving average. Interpretation. High standard deviation values occur when the data item being analyzed, example prices or an indicator, is changing dramatically. Similarly, low standard deviation values occur when prices are stable. Technical Analysis from A to Z. By Stephen B. Achelis. Many analysts feel that major tops are accompanied with high volatility as investors struggle with both euphoria and fear. Major bottoms are expected to be calmer as investors have few expectations of profits. Example. The following chart shows Procter & Gamble and its 10-week standard deviation. The extremely low standard deviation values at points A and B preceded significant rallies at points 1 and 2. Calculation. Where standard deviation is derived by calculating an n-period simple moving average of the data item, i.e., the closing price or an indicator, summing the squares of the difference between the data item and its moving average over each of the preceding n time periods. Dividing this sum by n, and then calculating the square root of this result. Technical Analysis from A to Z. By Stephen B. Achelis. STIX. Overview. STIX is a short-term trading oscillator that was published in the Polymetric Report. It compares the amount of volume flowing into advancing and declining stocks. Interpretation. According to the Polymetric Report, STIX usually ranges between +42 and +58. If STIX gets as low as 45, the market is almost always a buy, except in a raging bear market. The market is fairly overbought if STIX rises to 56, and except in a new bull market, it's wise to sell if STIX should go over 58. Traders and investors should modify these rough rules to suit their own objectives. In normal markets, STIX rarely gets as high as 56 or as low as 45, so rigid use of these rules of thumb would keep you inactive most of the time. For active accounts, the rules might be made much less stringent. Table 13. Extremely overbought greater than 58. Fairly overbought greater than 56. Fairly oversold less than 45. Extremely oversold less than 42. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows the S&P 500 and the STIX indicator. I drew buy arrows when the STIX fell below, and the rows above, the oversold level of 45. I drew sell arrows when the STIX rose above, and then fell below, the overbought. Level of 56. Calculation. Sticks is based on a variation of the advance/decline ratio. The sticks is a 21 period, i.e., 9%, exponential moving average of the above A/D ratio. Technical analysis from A to Z. By Stephen B. Achelis. Stochastic oscillator. Overview. Stochastic, stochastic, adjective 2. Math. Designating a process having an infinite progression of jointly distributed random variables. Webster's New World Dictionary. The stochastic oscillator compares where a security's price closed relative to its price range over a given time period. Interpretation. The stochastic oscillator is displayed as two lines. The main line is called %K. The second line, called %D, is a moving average of %K. The %K line is usually displayed as a solid line and the %D line is usually displayed as a dotted line. There are several ways to interpret a stochastic oscillator. 3 popular methods include 1. By when the oscillator, either %K or %D, falls below a specific level, example 20, and then rises above that level. Sell when the oscillator rises above a specific level, example 80, and then falls below that level. 2. Buy when the %K line rises above the %D line and sell when the %K line falls below the %D line. Look for divergences. For example, where prices are making a series of new highs and the stochastic oscillator is failing to surpass its previous highs. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows Avon Products and its 10-day stochastic. I drew buy arrows when the %K line fell below, and then rose above, the level of 20. Similarly, I drew sell arrows when the %K line rose above, and then fell below, the level of 80. This next chart also shows Avon Products. In this example I drew buy arrows each time the %K line rose above the %D dotted. Similarly, sell arrows were drawn when the %K line fell below the %D line. Technical analysis from A to Z. By Stephen B. Achelis. This final chart shows a divergence between the stochastic oscillator and prices. This is a classic divergence where prices are headed higher, but the underlying indicator, the stochastic oscillator, is moving lower. When a divergence occurs between an indicator and prices, the indicator typically provides the clue as to where prices will head. Calculation. The stochastic oscillator has 4 variables. 1% K periods. This is the number of time periods used in the stochastic calculation. 2% K slowing periods. This value controls the internal smoothing of %K. A value of 1 is considered a fast stochastic, a value of 3 is considered a slow stochastic. 3% D periods. This is the number of time periods used when calculating a moving average of %K. The moving average is called %D and is usually displayed as a dotted line on top of %K. 4% D. Method. The method, i.e., exponential, simple, time series, triangular, variable, or weighted, that is used to calculate %D. Technical analysis from A to Z. By Stephen B. Achelis. The formula for %K is. For example, to calculate a 10-day %K, first find the security's highest high and lowest low over the last 10 days. As an example, let's assume that during the last 10 days the highest high was 46 and the lowest low was 38, a range of 8 points. If today's closing price was 41, %K would be calculated as. The 37.5% in this example shows that today's close was at the level of 37.5% relative to the security's trading range over the last 10 days. If today's close was 42, the stochastic oscillator would be 50%. This would mean that the security closed today at 50%, or the midpoint, of its 10-day trading range. The above example used a %K slowing period of 1 day, no slowing. If you use a value greater than 1, you average the highest high and the lowest low over the number of %K slowing periods before performing the division. A moving average of %K is then calculated using the number of time periods specified in the %D periods. This moving average is called %D. The stochastic oscillator always ranges between 0% and 100%. A reading of 0% shows that the security's close was the lowest price that the security has traded during the preceding X time periods. A reading of 100% shows that the security's close was the highest price that the security has traded during the preceding X time periods. Swing Index Overview. Developed by Wells Wilder, the swing index seeks to isolate the real price of a security by comparing the relationships between the current prices, i.e., open, high, low, and close, and the previous period's prices. Interpretation. The swing index is primarily used as a component of the Accumulation Swing Index. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows the British pound and the swing index. You can see that by itself, the swing index is an erratic plot. The value of this indicator develops when it is accumulated into the Accumulation Swing Index. Calculation. Although it is beyond the scope of this book to completely define the swing index, the basic formula is shown below. Step-by-step instructions on calculating the swing index are provided in Wilder's book, New Concepts in Technical Trading Systems. Technical Analysis from A to Z. By Stephen B. Achelis. Where the following table lists the limit moves for several commodities. You can get a list of limit moves from your broker. Table 14. Commodity limit move. Coffee, 6 cents. Gold, $75. Heating oil, 4 cents. Hogs, $0.015. Soybeans, 30 cents. T-bonds, $3. You may need to adjust the limit moves shown in the above table based on the position of the decimal in your data. For example, if the price of corn is quoted as $2.45, the limit move would be 10 cents. However, if the price of corn is quoted as $245, the limit move would be $10. If the security does not have a limit move, example a stock or some futures, use an extremely high value, example $30,000. Technical Analysis from A to Z. By Stephen B. Achelis. 3-line break. Overview. 3-line break charts display a series of vertical boxes, lines, that are based on changes in prices. As with Kajai, point and figure, and Renko charts, 3-line break charts ignore the passage of time. The 3-line break charting method is so named because of the number of lines typically used. 3-line break charts were first brought to the United States by Stephen Nizan when he published the book, Beyond Candlesticks. Interpretation. The following are the basic trading rules for a 3-line break chart. Buy when a white line emerges after 3 adjacent black lines, a white turnaround line. Sell when a black line appears after 3 adjacent white lines, a black turnaround line. Avoid trading in trendless markets where the lines alternate between black and white. An advantage of 3-line break charts is that there is no arbitrary fixed reversal amount. It is the price action which gives the indication of a reversal. The disadvantage of 3-line break charts is that the signals are generated after the new trend is well underway. However, many traders are willing to accept the late signals in exchange for calling major trends. You can adjust the sensitivity of the reversal criteria by changing the number of lines in the break. For example, short-term traders might use 2-line breaks to get more reversals, while a longer-term investor might use 4-line or even 10-line breaks to reduce the number of reversals. The 3-line break is the most popular in Japan. Steven Nissen recommends using 3-line break charts in conjunction with candlestick charts. He suggests using the 3-line break chart to determine the prevailing trend, and then using candlestick patterns to time your individual trades. Technical Analysis from A to Z by Stephen B. Achelis. Example: the following illustration shows a 3-line break and a bar chart of Apple Computer. You can see that the number of break lines in a given month depend on the price change during the month. For example, June has many lines because the prices changed significantly, whereas November only has 2 lines because prices were relatively flat. Calculation: line break charts are always based on closing prices. The general rules for calculating a line break chart are: if the price exceeds the previous line's high price, a new white line is drawn. If the price falls below the previous line's low price, a new black line is drawn. If the price does not rise above nor fall below the previous line, nothing is drawn. In a 3-line break chart, if rallies are strong enough to display 3 consecutive lines of the same color, then prices must reverse by the extreme price of the last 3 lines in order to create a new line. If a rally is powerful enough to form 3 consecutive white lines, then prices must fall below the lowest point of the last 3 white lines before a new black line is drawn. Technical Analysis from A to Z by Stephen B. Achelis. If a sell-off is powerful enough to form 3 consecutive black lines, then prices must rise above the highest point of the last 3 black lines before a new white line is drawn. Time series forecast. Overview. The time series forecast indicator displays the statistical trend of a security's price over a specified time period. The trend is based on linear regression analysis. Rather than plotting a straight linear regression trend line, the time series forecast plots the last point of multiple linear regression trend lines. The resulting time series forecast indicator is sometimes referred to as the moving linear regression indicator or the regression oscillator. Interpretation. The interpretation of a time series forecast is identical to a moving average. However, the time series forecast indicator has 2 advantages over classic moving averages. Unlike a moving average, a time series forecast does not exhibit as much delay when adjusting to price changes, since the indicator is fitting itself to the data rather than averaging them. The time series forecast is more responsive to price changes. As the name suggests, you can use the time series forecast to forecast the next period's price. This estimate is based on the trend of the security's prices over the period specified. Example: 20 days. If the current trend continues, the value of the time series forecast is a forecast of the next period's price. Technical Analysis from A to Z by Stephen B. Achelis. Example: the following chart shows a 50-day time series forecast of Microsoft's prices. I've also drawn 3 50-day long linear regression trend lines. You can see that the ending point of each trend line is equal to the value of the time series forecast. Calculation. The time series forecast is determined by calculating a linear regression trend line using the least squares fit method. The least squares fit technique fits a trend line to the data in the chart by minimizing the distance between the data points and the linear regression trend line. Click here to go to the formula for a linear regression trend line. Tyrone levels. Overview. Tyrone levels are a series of horizontal lines that identify support and resistance levels. They were developed by John Tyrone. Interpretation. Tyrone levels can be drawn using either the midpoint 1/3-2/3 method or the mean method. Both methods are intended to help you identify potential support and resistance levels based on the range of prices over a given time period. The interpretation of Tyrone levels is similar to quadrant lines. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows midpoint Tyrone levels on Lincoln National. The dotted line shows the average price. The top and bottom lines divide the range between the highest and lowest prices into thirds. Calculation. Midpoint method. Midpoint levels are calculated by finding the highest high and the lowest low during the time period being analyzed. The lines are then calculated as follows. Top line. Subtract the lowest low from the highest high, divide this value by 3, and then subtract this result from the highest high. Center line. Subtract the lowest low from the highest high, divide this value by 2, and then add this result to the lowest low. Bottom line. Subtract the lowest low from the highest high, divide this value by 3, and then add this result to the lowest low. Technical analysis from A to Z. By Stephen B. Achelis. Mean method. Mean levels are displayed as 5 lines, the spacing between the lines is not necessarily symmetrical. The lines are calculated as follows. Extreme high. Subtract the lowest low from the highest high and add this value to the adjusted mean. Regular high. Subtract the lowest low from the value of the adjusted mean multiplied by 2. Adjusted mean. This is the sum of the highest high, the lowest low, and the most recent closing price, divided by 3. Regular low. Subtract the highest high from the value of the adjusted mean multiplied by 2. Extreme low. Subtract the lowest low from the highest high and then subtract this value from the adjusted mean. Total short ratio. Overview. The total short ratio, TSR, shows the percentage of short sales to the total volume on the New York Stock Exchange. Interpretation. As with the public short ratio, the total short ratio takes the contrarian view that short sellers are usually wrong, while the odd lotters are typically the worst of the short sellers. History has shown that even the specialists tend to overshort at market bottoms. The TSR shows investor expectations. High values indicate bearish expectations and low values indicate bullish expectations. Taking a contrarian stance, when there are high levels of shorts, many investors expect a market decline. We would expect the market to rise. Likewise, extremely low levels of short sales should indicate excessive optimism and the increased likelihood of a market decline. The interpretation of all of the short sale indicators has become more difficult recently due to option hedging and arbitrage. However, they are still helpful in determining overall market expectations. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows the New York Stock Exchange and a 10-week moving average of the total short ratio. I drew by arrows each time investors were excessively bearish. In hindsight, each of these turned out to be excellent times to enter the market. Calculation. The total short ratio is calculated by dividing the total number of short sales by the total number of buy and sell orders. Both of these figures are reported weekly, on Fridays, by the NYSE Trade Volume Index. Overview. The Trade Volume Index, TVI, shows whether a security is being accumulated, purchased, or distributed, sold. The TVI is designed to be calculated using intraday tick price data. The TVI is based on the premise that trades taking place at higher asking prices are buy transactions and trades at lower bid prices are sell transactions. Technical Analysis from A to Z. By Stephen B. Achelis. Interpretation. The TVI is very similar to on-balance volume. The OBV method works well with daily prices, but it doesn't work as well with intraday tick prices. Tick prices, especially stock prices, often display trades at the bid or ask price for extended periods without changing. This creates a flat support or resistance level in the chart. During these periods of unchanging prices, the TVI continues to accumulate this volume on either the buy or sell side, depending on the last price change. The TVI helps identify whether a security is being accumulated or distributed. When the TVI is trending up, it shows that trades are taking place at the asking price as buyers accumulate the security. When the TVI is trending down, it shows that trades are taking place at the bid price as sellers distribute the security. When prices create a flat resistance level and the TVI is rising, look for prices to break out to the upside. When prices create a flat support level and the TVI is falling, look for prices to drop below the support level. Example. The following chart shows IBM's tick prices and TVI. During the 45 minutes leading up to the point labeled A, prices were locked in a tight range between the bid price of 69 1/4 and the asking price of 69 3/8. During this same period, the TVI was trending upward, which showed the prices were slowly being accumulated. Calculation. The trade volume index is calculated by adding each trade's volume to accumulative total when the price moves up by a specified amount, and subtracting the trade's volume. Technical Analysis from A to Z. By Stephen B. Achelis. When the price moves down by a specified amount, the specified amount is called the minimum tick value. To calculate the TVI, you must first determine if prices are being accumulated or distributed. Once you know the direction, you can then calculate the TVI. Trend lines. Overview. One of the basic tenets put forth by Charles Dow in the Dow theory is that security prices do trend. Trends are often measured and identified by trend lines. A trend line is a sloping line that is drawn between two or more prominent points on a chart. Rising trends are defined by a trend line that is drawn between two or more troughs, low points, to identify price support. Falling trends are defined by trend lines that are drawn between two or more peaks, high points, to identify price resistance. Interpretation. A principle of technical analysis is that once a trend has been formed, two or more peaks/troughs have touched the trend line and reverse direction, it will remain intact until broken. Technical Analysis from A to Z. By Stephen B. Achelis. That sounds much more simplistic than it is. The goal is to analyze the current trend using trend lines and then either invest with the current trend until the trend line is broken, or wait for the trend line to be broken and then invest with the new, opposite, trend. One benefit of trend lines is they help distinguish emotional decisions, I think it's time to sell, from analytical decisions, I will hold until the current rising trend line is broken. Another benefit of trend lines is that they almost always keep you on the right side of the market. When using trend lines, it's difficult to hold a security for very long. When prices are falling just as it's hard to be short when prices are rising, either way the trend line will be broken. Example. The following chart shows Goodyear along with several trend lines. Trend lines A and C are falling trend lines. Note how they were drawn between successive peaks. Trend lines B and D are rising trend lines. They were drawn between successive troughs in the price. Tricks. Overview. TRIX is a momentum indicator that displays the percent rate of change of a triple exponentially smoothed moving average of the security's closing price. It is designed to keep you in trends equal to or shorter than the number of periods you specify. Technical analysis from A to Z. By Stephen B. Achelis. Interpretation. The TRIX indicator oscillates around a zero line. Its triple exponential smoothing is designed to filter out insignificant cycles, i.e., those that are shorter than the number of periods you specify. Trades should be placed when the indicator changes direction, i.e., buy when it turns up, and sell when it turns down. You may want to plot a 9-period moving average of the TRIX to create a signal line, similar to the MACD indicator, and then buy when the TRIX rises above its signal, and sell when it falls below its signal. Divergences between the security and the TRIX can also help identify turning points. Example. The following chart shows checker drive-in, its 12-day TRIX, solid line, and a 9-day signal moving average of the TRIX, dotted line. I drew buy arrows when the TRIX rose above its signal line and drew sell arrows when it fell below its signal line. This method worked well when prices were trending, but it generated numerous false signals when prices were moving sideways. A bearish divergence occurred when the TRIX was falling, trendline A, while prices rose. Prices subsequently corrected. Similarly, a bullish divergence occurred when the TRIX was rising, trendline B, while prices were falling. Prices subsequently rallied. Technical analysis from A to Z. By Stephen B. Achelis. Calculation. To calculate the TRIX indicator. 1. Calculate an n-period exponential moving average of the closing prices. 2. Calculate an n-period exponential moving average of the moving average. Calculated in step number 1. 3. Calculate an n-period exponential moving average of the moving average. Calculated in step number 2. 4. Calculate the 1-period, example 1 day, percent change of the moving average. Calculated in step number 3. Typical price. Overview. The typical price indicator is simply an average of each day's price. The median price and weighted close are similar indicators. Interpretation. The typical price indicator provides a simple, single-line plot of the day's average price. Some investors use the typical price rather than the closing price when creating moving average penetration systems. The typical price is a building block of the money flow index. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows the typical price indicator on top of value lines bar chart. Calculation. The typical price indicator is calculated by adding the high, low, and closing prices together, and then dividing by 3. The result is the average, or typical price. Ultimate oscillator. Overview. Oscillators typically compare a security's smoothed price with its price X periods ago. Larry Williams noted that the value of this type of oscillator can vary greatly depending on the number of time periods used during the calculation. Thus, he developed the ultimate oscillator that uses weighted sums of 3 oscillators, each of which uses a different time period. The 3 oscillators are based on Williams' definitions of buying and selling pressure. Interpretation. Williams recommends that you initiate a trade following a divergence and a breakout in the ultimate oscillator's trend. The following text summarizes these rules. Technical analysis from A to Z. By Stephen B. Achelis. By when 1. A bullish divergence occurs. This is when the security's price makes a lower low that is not confirmed by a lower low in the oscillator. 2. During the bullish divergence, the oscillator falls below 30. 3. The oscillator then rises above the highest point reached during the span of the bullish divergence. This is the point at which you buy. Close long positions when the conditions are met to sell short, explained below, or the oscillator rises above 50 and then falls below 45, or the oscillator rises above 70. I sometimes wait for the oscillator to then fall below 70. Sell short when 1. A bearish divergence occurs. This is when the security's price makes a higher high that is not confirmed by a higher high in the oscillator. 2. During the bearish divergence, the oscillator rises above 50. 3. The oscillator then falls below the lowest point reached during the span of the bearish divergence. This is the point at which you sell short. Close short positions when the conditions are met to buy long, explained above, or the oscillator rises above 65, or the oscillator falls below 30. I will sometimes wait for the oscillator to then rise above 30. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows AutoZone and its ultimate oscillator. I drew sell arrows when the conditions for a sell signal were met. A bearish divergence occurred, lines A, when prices made a new high that was not confirmed by the oscillator. The oscillator rose above 50 during the divergence. The oscillator fell below the lowest point reached during the span of the divergence, line B. Similarly, I drew buy arrows when the conditions for a buy signal were met. A bullish divergence occurred, lines C, then prices made a new low that was not confirmed by the oscillator. The oscillator fell below 30 during the divergence. The oscillator rose above the highest point reached during the span of the divergence, line D. Technical Analysis from A to Z. By Stephen B. Achelis. Upside/downside ratio. Overview. The upside/downside ratio shows the relationship between up, advancing, and down, declining, volume on the New York Stock Exchange. Click here for more information on advancing, declining, and unchanged volume. Interpretation. When the upside/downside ratio is greater than 1.0, it is showing that there is more volume associated with stocks that are increasing in price than with stocks that are decreasing in price. While discussing advancing/declining volume in his book, Winning on Wall Street, Martin Zweig states, every bull market in history, and many good intermediate advances, have been launched with a buying stampede that included one or more 9-to-1 days. 9-to-1 refers to a day where the upside/downside ratio is greater than 9. He goes on to say, the 9-to-1 up day is a most encouraging sign, and having two of them within a reasonably short span is very bullish. I call it a double 9-to-1 when two such days occur with 3 months of one another. Table 15, originally tabulated through 1984 by Martin Zweig, shows all of the double 9-to-1 buy signals that occurred from 1962 to October 1994. As of this writing, no signals have occurred since the last one on June 8, 1988. Table 15. Date. DJIA. Percent. Change. 3 months later. November 12, 62. 624. Plus 8.5. Plus 15.9. Plus 20.2. November 19, 63. 751. Plus 6.9. Plus 9.1. Plus 16.5. October 12, 66. 778. Plus 6.9. Plus 8.6. Plus 17.4. May 27, 70. 663. Plus 14.6. Plus 17.8. Plus 16.5. November 19, 71. 830. Plus 11.8. Plus 17.0. Plus 22.8. September 19, 75. 830. Plus 1.7. Plus 18.1. Plus 19.9. April 22, 80. 790. Plus 11.8. Plus 17.0. Plus 22.8. Percent. Percent. Change. Change 6. 12. Months. Months. Later. Later. Technical Analysis from A to Z. By Stephen B. Achelis. March 22, 82. 820. Minus 2.4. Plus 13.2. Plus 37.0. August 20, 82. 869. Plus 15.1. Plus 24.3. Plus 38.4. January 6, 83. 1071. Plus 3.9. Plus 14.0. Plus 20.2. August 2, 84. 1166. Plus 4.4. Plus 10.6. Plus 16.0. November 23, 84. 1220. Plus 4.7. Plus 6.2. Plus 19.3. January 2, 87. 1927. Plus 20.4. Plus 26.4. Plus 4.6. October 29, 87. 1938. Plus 1.0. Plus 4.9. Plus 10.8. January 4, 88. 2015. Minus 1.7. Plus 7.1. Plus 8.0. June 8, 88. 2102. Minus 1.9. Plus 1.9. Plus 19.7. Average. Plus 6.4 slash quarter plus 12.5 slash half plus 18.4 slash year. Example. The following chart shows the Dow Jones Industrial Average during most of the 1980s. I drew buy arrows on the chart where double 9 to 1 buy signals occurred. Technical Analysis from A to Z. By Stephen B. Achelis. Calculation. The upside/downside ratio is calculated by dividing the daily volume of advancing stocks by the daily volume of declining stocks. Upside-downside volume. Overview. The upside-downside volume indicator shows the difference between up, advancing, and down, declining, volume on the New York Stock Exchange. Click here for more information on advancing, declining, and unchanged volume. Interpretation. The upside-downside volume indicator shows the net flow of volume into or out of the market. A reading of plus 40 indicates that up volume exceeded down volume by 40 million shares. Likewise, a reading of minus 40 would indicate that down volume exceeded up volume by 40 million shares. The indicator is useful to compare today's volume action with previous days. Currently, normal readings are in the area of 50. Very active days exceed 150 million shares. The October 1987 crash reached minus 602. The cumulative volume index is a cumulative total of the upside-downside volume indicator. Technical Analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows the Dow Jones Industrial Average and the upside-downside volume indicator. I labeled the DJIA with buy arrows when the upside-downside volume indicator was greater than 200 and with sell arrows when the indicator was less than minus 200. Calculation. The upside-downside volume indicator is calculated by subtracting the daily volume of advancing stocks by the daily volume of declining stocks. Vertical horizontal filter. Overview. The vertical horizontal filter, VHF, determines whether prices are in a trending phase or a congestion phase. The VHF was first presented by Adam White in an article published in the August, 1991 issue of Futures magazine. Interpretation. Probably the biggest dilemma in technical analysis is determining if prices are trending or are in a trading range. Trend following indicators such as the MACD and moving technical analysis from A to Z. By Stephen B. Achelis. Averages are excellent in trending markets, but they usually generate multiple conflicting trades during trading range, or congestion, periods. On the other hand, oscillators such as the RSI and stochastics work well when prices fluctuate within a trading range, but they almost always close positions prematurely during trending markets. The VHF indicator attempts to determine the trendiness of prices to help you decide which indicators to use. There are three ways to interpret the VHF indicator. 1. You can use the VHF values themselves to determine the degree that prices are trending. The higher the VHF, the higher the degree of trending and the more you should be using trend following indicators. 2. You can use the direction of the VHF to determine whether a trending or congestion phase is developing. A rising VHF indicates a developing trend, a falling VHF indicates that prices may be entering a congestion phase. 3. You can use the VHF as a contrarian indicator. Expect congestion periods to follow high VHF values, expect prices to trend following low VHF values. Example. The following chart shows Motorola and the VHF indicator. The VHF indicator was relatively low from 1989 through most of 1992. These low values showed that prices were in a trading range. From late 1992 through 1993 the VHF was significantly higher. These higher values indicated that prices were trending. The 40-week, i.e., 200-day, moving average on Motorola's prices demonstrates the value of the VHF indicator. You can see that a classic moving average trading system, buy when prices rise above their moving average and sell when prices fall below their technical analysis from A to Z. By Stephen B. Achelis. Average, worked well in 1992 and 1993, but generated numerous whipsaws when prices were in a trading range. Calculation. To calculate the VHF indicator, first determine the highest closing price, HCP, and the lowest closing price, LCP, over the specified time period, often 28 days. Next, subtract the lowest closing price from the highest closing price and take the absolute value of this difference. This value will be the numerator. To determine the denominator, sum the absolute value of the difference between each day's price and the previous day's price over the specified time periods. The VHF is then calculated by dividing the previously defined numerator by the denominator. Volatility, Chaikin's. Overview. Chaikin's volatility indicator compares the spread between a security's high and low prices. It quantifies volatility as a widening of the range between the high and the low price. Interpretation. There are two ways to interpret this measure of volatility. One method assumes that market tops are generally accompanied by increased volatility, as investors get nervous and indecisive, and that the latter stages of a market bottom are generally accompanied by decreased volatility, as investors get bored. Technical analysis from A to Z. By Stephen B. Achelis. Another method, Mr. Chaikin's, assumes that an increase in the volatility indicator over a relatively short time period indicates that a bottom is near, example a panic sell-off, and that a decrease in volatility over a longer time period indicates an approaching top, example a Mature bull market. As with almost all experienced investors, Mr. Chaikin recommends that you do not rely on any one indicator. He suggests using a moving average penetration or trading band system to confirm this, or any indicator. Example. The following chart shows the Eurodollar and Chaikin's volatility indicator. The indicator reached a rapid peak following a panic sell-off, point A. This indicated that a bottom was near, point B. Calculation. Chaikin's volatility is calculated by first calculating an exponential moving average of the difference between the daily high and low prices. Chaikin recommends a 10-day moving average. Next, calculate the percent that this moving average has changed over a specified time period. Chaikin again recommends 10 days. Technical Analysis from A to Z. By Stephen B. Achelis. Volume. Overview. Volume is simply the number of shares, or contracts, traded during a specified time frame, example hour, day, week, month, etc. The analysis of volume is a basic yet very important element of technical analysis. Volume provides clues as to the intensity of a given price move. Interpretation. Low volume levels are characteristic of the indecisive expectations that typically occur during consolidation periods, i.e., periods where prices move sideways in a trading range. Low volume also often occurs during the indecisive period during market bottoms. High volume levels are characteristic of market tops when there is a strong consensus that prices will move higher. High volume levels are also very common at the beginning of new trends, i.e., when prices break out of a trading range just before market bottoms. Volume will often increase due to panic-driven selling. Volume can help determine the health of an existing trend. A healthy uptrend should have higher volume on the upward legs of the trend, and lower volume on the downward corrective legs. A healthy downtrend usually has higher volume on the downward legs of the trend and lower volume on the upward corrective legs. Example. The following chart shows Merck and its volume. Technical Analysis from A to Z. By Stephen B. Achelis. Prices peaked at the end 1991 following a long rally. This was followed by a price decline, trendline A1. Notice how volume was relatively high during this price decline. Trendline A2. The increase in volume during the price decline showed that many investors would sell when prices declined. This was bearish. Prices then tried to rally, trendline B1. However, volume decreased dramatically. Trendline B2, during this rally. This showed that investors were not willing to buy, even when prices were rising. This too was bearish. This pattern continued throughout the decline in 1992 and 1993. When prices rallied, they did so on decreased volume. When prices declined, they did so on increased volume. This showed, again and again, that the bears were in control and that prices would continue to fall. Volume oscillator. Overview. The volume oscillator displays the difference between two moving averages of a security's volume. The difference between the moving averages can be expressed in either points or percentages. Interpretation. You can use the difference between two moving averages of volume to determine if the overall volume trend is increasing or decreasing. When the volume oscillator rises above 0, it signifies that the shorter-term volume moving average has risen above the longer-term volume moving average, and thus, that the short-term volume trend is higher, i.e., more volume, than the longer-term volume trend. There are many ways to interpret changes in volume trends. One common belief is that rising prices coupled with increased volume, and falling prices coupled with decreased volume, is bullish. Conversely, if volume increases when prices fall, and volume decreases when prices rise, the market is showing signs of underlying weakness. The theory behind this is straightforward. Rising prices coupled with increased volume signifies increased upside participation, more buyers, that should lead to a continued move. Conversely, falling prices coupled with increased volume, more sellers, signifies decreased upside participation. Technical analysis from A to Z. By Stephen B. Achelis. Example. The following chart shows Xerox and 5/10-week volume oscillator. I drew linear regression trend lines on both the prices and the volume oscillator. This chart shows a healthy pattern. When prices were moving higher, as shown by rising linear regression trend lines, the volume oscillator was also rising. When prices were falling, the volume oscillator was also falling. Calculation. The volume oscillator can display the difference between the two moving averages as either points or percentages. To see the difference in points, subtract the longer term moving average of volume from the shorter term moving average of volume. To display the difference between the moving averages in percentages, divide the difference between the two moving averages by the shorter term moving average. Technical analysis from A to Z. By Stephen B. Achelis. Volume rate of change. Overview. The volume rate of change, ROC, is calculated identically to the price ROC, except it displays the ROC of the security's volume, rather than of its closing price. Interpretation. Almost every significant chart formation, example tops, bottoms, breakouts, etc., is accompanied by a sharp increase in volume. The volume ROC shows the speed at which volume is changing. Additional information on the interpretation of volume trends can be found in the discussions on volume and on the volume oscillator. Example. The following chart shows Texas Instruments and its 12-day volume ROC. When prices broke out of the triangular pattern, they were accompanied by a sharp increase in volume. The increase in volume confirmed the validity of the price breakout. Calculation. The volume rate of change indicator is calculated by dividing the amount that volume has changed over the last n periods by the volume n periods ago. The result is the percentage that the volume has changed in the last n periods. Technical analysis from A to Z. By Stephen B. Achelis. If the volume is higher today than n periods ago, the ROC will be a positive number. If the volume is lower today than n periods ago, the ROC will be a negative number. Weighted close. Overview. The weighted close indicator is simply an average of each day's price. It gets its name from the fact that extra weight is given to the closing price. The median price and typical price are similar indicators. Interpretation. When plotting and backtesting moving averages, indicators, trend lines, etc., some investors like the simplicity that a line chart offers. However, line charts that only show the closing price can be misleading since they ignore the high and low price. A weighted close chart combines the simplicity of the line chart with the scope of a bar chart, by plotting a single point for each day that includes the high, low, and closing price. Example. The following chart shows the weighted close plotted on top of a normal high/low/close bar chart of PeopleSoft. Technical analysis from A to Z. By Stephen B. Achelis. Calculation. The weighted close indicator is calculated by multiplying the close by 2, adding the high and the low to this product, and dividing by 4. The result is the average price with extra weight given to the closing price. Williams accumulation/distribution. Overview. Accumulation is a term used to describe a market controlled by buyers, whereas distribution is defined by a market controlled by sellers. Interpretation. Williams recommends trading this indicator based on divergences. Distribution of the security is indicated when the security is making a new high, and the A/D indicator is failing to make a new high. Sell. Accumulation of the security is indicated when the security is making a new low, and the A/D indicator is failing to make a new low. Buy. Example. The following chart shows Procter, accumulation/distribution indicator, and Gamble, and the Williams. Technical analysis from A to Z. By Stephen B. Achelis. A bearish divergence occurred when the prices were making a new high, point A2, and the A/D indicator was failing to make a new high, point A1. This was the time to sell. Calculation. To calculate Williams' accumulation/distribution indicator, first determine the true range high, TRH, and true range low, TRL. Today's accumulation/distribution is then determined by comparing today's closing price to yesterday's closing price. If today's close is greater than yesterday's close. If today's close is less than yesterday's close. If today's close is equal to yesterday's close. The Williams accumulation/distribution indicator is a cumulative total of these daily values. Williams %R. Overview. Williams %R, pronounced %R, is a momentum indicator that measures overbought/oversold levels. Williams %R was developed by Larry Williams. Interpretation. The interpretation of Williams %R is very similar to that of the stochastic oscillator. Page 244, except that %R is plotted upside down and the stochastic oscillator has internal smoothing. Technical analysis from A to Z. By Stephen B. Achelis. To display the Williams %R indicator on an upside-down scale, it is usually plotted using negative values, example -20%. For the purpose of analysis and discussion, simply ignore the negative symbols. Readings in the range of 80 to 100% indicate that the security is oversold, while readings in the 0 to 20% range suggest that it is overbought. As with all overbought/oversold indicators, it is best to wait for the security's price to change direction before placing your trades. For example, if an overbought/oversold indicator, such as the stochastic oscillator or Williams %R, is showing an overbought condition, it is wise to wait for the security's price to turn down before selling the security. The MACD is a good indicator to monitor change in a security's price. It is not unusual for overbought/oversold indicators to remain in an overbought/oversold condition for a long time period as the security's price continues to climb/fall. Selling simply because the security appears overbought may take you out of the security long before its price shows signs of deterioration. An interesting phenomena of the %R indicator is its uncanny ability to anticipate a reversal in the underlying security's price. The indicator almost always forms a peak and turns down a few days before the security's price peaks and turns down. Likewise, %R usually creates a trough and turns up a few days before the security's price turns up. Example. The following chart shows the OEX index and its 14-day Williams %R. I drew by arrows each time the %R formed a trough below 80%. You can see that in almost every case this occurred 1 or 2 days before the prices bottomed. Technical analysis from A to Z. By Stephen B. Achelis. Calculation. The formula used to calculate Williams %R is similar to the stochastic oscillator. Zigzag. Overview. The zigzag indicator filters out changes in an underlying plot, example a security's price or another indicator, that are less than a specified amount. The zigzag indicator only shows Significant changes. Interpretation. The zigzag indicator is used primarily to help you see changes by punctuating the most significant reversals. It is very important to understand that the last leg displayed in a zigzag chart can change based on changes in the underlying plot, example prices. This is the only indicator in this book where a change in the security's price can change a previous value of the indicator. Since the zigzag indicator can adjust its values based on subsequent changes in the underlying plot, it has perfect hindsight into what prices have done. Please don't try to create a trading system based on the zigzag indicator. Its hindsight is much better than its foresight. In addition to identifying significant prices reversals, the zigzag indicator is also useful when doing Elliott wave counts. For additional information on the zigzag indicator, refer to Filtered Waves by Arthur Merrill. Technical Analysis from A to Z by Stephen B. Achelis. Example. The following chart shows the 8% zigzag indicator plotted on top of Madel's bar chart. This zigzag indicator ignores changes in prices that are less than 8%. Calculation. The zigzag indicator is calculated by placing imaginary points on the chart when prices reverse by at least the specified amount. Straight lines are then drawn to connect these imaginary points. Technical Analysis from A to Z by Stephen B. Achelis. Bibliography. Appel, Gerald, and Hitchler, Fred. Stock Market Trading Systems. Homewood, Illinois, Dow. Jones-Irwin, 1980. Appel, Gerald. The Moving Average Convergence-Divergence Method. Great Neck. New York, Sign Alert, 1979. Arms, Richard W., Jr. The Arms Index, Trin. Homewood, Illinois, Dow Jones-Irwin, 1989. Arms, Richard W., Jr. Volume Cycles in the Stock Market. Salt Lake City, Utah, Equus. International Incorporated, 1994. Cohen, A.W. How to Use the Three-Point Reversal Method of Point and Figure Stock Market Trading. Larchmont, New York, Chartcraft, 1984. Dobson, Edward D. Understanding Fibonacci Numbers. Greenville, South Carolina, Traders Press. 1984. Edwards. Roberts D. and McGee, John. Technical Analysis of Stock Trends. 6th edition. Boston Mott, John McGee Incorporated, 1992, distributed by New York Institute of Finance. Fosbach, Norman G. Stock Market Logic. Chicago, I.L., Dearborn Financial Publishing. Inc., 1992. Frost, A.J., and Prechter, Robert. Elliott Wave Principle. Gainesville, Georgia, New Classics. Library Incorporated, 1985. Granville, Joseph E. New Strategy of Daily Stock Market Timing Form Maximum Profits. Englewood Cliffs, New Jersey, Prentice Hall, 1976. McClellan, Sherman, and Marion. Patterns for Profit, the McClellan Oscillator and Summation Index. Lakewood, Washington, McClellan Financial Publications Incorporated, 1989. Merrill, Arthur. Filtered Waves Basic Theory. Chappaqua, New York, The Analysis Press. 1977, available from Technical Trends, P.O. Box 792 Wilton, Connecticut, 06897. Natenberg, Sheldon. Option Volatility and Pricing Strategies, Revised Edition. Chicago. I.L., Probus Publishing Company, 1994. Nizan, Steve. Beyond Candlesticks. New York, New York, John Wiley & Sons, 1994. Nizan, Steve. Japanese Candlestick Charting Techniques. New York, McGraw-Hill, Inc., 1991. Technical Analysis from A to Z. By Stephen B. Achelis. O'Neill, William J. How to Make Money in Stocks. Second edition. New York, New York. McGraw-Hill, Inc., 1995. Pring, Martin J. Technical Analysis Explained. Third edition. New York, New York, Trend. Research, 1978. Wilder, J. Wells. New Concepts in Technical Trading Systems. Greensboro, North Carolina, Trend. Research, 1978. Zweig, Martin. Winning on Wall Street. New York, New York, Warner Books, 1986.